Good evening, everyone. I hope my voice is audible to all of you. We have quite a good number of students to start with. Please give me a quick confirmation over the chat box on
Good evening,
YouTube
everyone. I hope my
if I'm audible to you or not. Yes, is the voice audible? I'm visible, screen is visible. Quick system check. That's great. That's great. Okay. So, welcome you all to the SBR Grand Revision for March 2026 quarter. And I hope if you are here for the Grand Revision, you must have already prepared well for the paper of SBR. Now, this exam is what, as a brief introduction of mine, this is an exam that I have been teaching since 5+ years now. So, I can confidently say that this session is going to be super productive for you. You are going to have that, the information which was scattered here and there, where you were thinking like, okay, I remember this, but I don't remember that part of the standard. And what if it comes up in the case study, what I'll do? All that scattered information, we are going to bring it into one place. We'll try our best to do that. So I want your attention throughout the session. I want your high energy. It is not a race, it's a marathon today. Okay. So it is going to be for 4 hours. So we need to be on high energy throughout the 4 hours and attentive. Okay. So whatever I say, that should go directly into your head. So if you want, you can keep a glass of water in front of you. You should sit back straight. You should have your copies open. If you think that, okay, something is very different, which Tashwita has just told us, let me write it down. No problem, write it down. Howsoever, whatever I am writing on the board today, you'll get the PDF of it. Whatever is written, annotated, you'll get the PDF of it. Even still, if you want, you can still take handwritten notes. Okay. So high energy, you have to participate in the class. I'm looking at the chat box, I'm looking at your messages, and you have to concentrate 4 hours straight into the session. So let's begin with the class today. And this is going to be the most helpful session. I've taken so many feedbacks from so many students, whether they were enrolled with me or not. They always say that, ma'am, the grand revision helped us pass. Some people who sit for their interviews in Big Four, they use the grand revision for their interviews as well. So hi to all, whoever is using this currently or in future. Throw a like, throw a comment. That will help me to reach more students who can help from this free resource. Okay, so guys, let's begin with SBR. Now, strategic business reporting. What kind of paper is this? You all have seen a lot of past papers, you have seen a lot of standards so far, but what exactly this paper consists? It is consisting IFRS, and I am supposed to know the IFRS and I am supposed to apply it in a case study. Okay, so application is very important for that perspective. That's why we are trained as ACCAs. So when you get ill, when you get a fever, do you go to a doctor, right? The first thing that you expect from the doctor is that he should be able to cure fever. At least he should do that, right? That's the bare minimum. He should know whether to take paracetamol or whether to take another medicine. Similarly, if you go to a chartered accountant, you go to a CPA, you go to an ACCA, what do you expect from him? Basic expectation is that he should know accounting. Basic expectation is that he should know IFRS, how to prepare financial statements, right? So this is what we learn in strategic business reporting. This is the core and heart of the ACCA qualification. If you know IFRS, you are very industry ready and you are looked up as an expert. Howsoever, I believe, given the era where we have AI now, we should not be focusing on cramming the rules and the standards. It should be more on application. So that's how ACCA is also, I would say, abiding by this and adapting to this. Now they're not more focused on you cramming a standard, but they care about how do you apply that in a given situation. Now, all these IFRSs, guys, these are international financial reporting standards. International financial reporting standards. Now, these are prepared by certain body that is termed as IASB, right? Now, this body has actually kept certain principles before making IFRSs. These principles are known as conceptual framework. Like, for example, guys, I want to open a school and I'm the principal of the school. Let's imagine for the wildest fantasy that I'm the principal of the school and I want to make rules for my students. What will be my conceptual framework? What will be the like reason behind many rules that I will make? I want to I want to imbibe discipline in the students. I want to make good future professionals, future citizens. So I want to give them some moral science understanding, like ethics. So discipline, ethics, good human beings, having good education. So these will be my objectives, right? According to these objectives, I will make rules of my school. So similarly, when these accounting rules were made, what are IFRSs? Nothing but accounting rules. So when these accounting rules were made, there has to be some framework, there has to be some principle on which they are based. That is conceptual framework. And this conceptual framework, guys, it was revised in 2018. So you should know the revision that happened in 2018. It can be tested in SBR. You have a question in SBR Kaplan Kit, Margi company, where they have tested you on the changes in conceptual framework in 2018. Now, let's understand what's there in conceptual framework. In conceptual framework, they have given you the various definitions. Definition of an asset, definition of a liability, definition of an income, definition of an expense, definition of an equity. All these are given to us in the conceptual framework. What do you mean by asset? Asset is anything that will lead to inflow of economic resources. Okay. It will lead to inflow of economic resources due to some past event, right? And previously we used to talk about probability here. Previously, we used to talk about probability here, but post 2018, we have removed the concept of probability. Now we don't say probable economic inflow. Now we just say economic inflow of resources due to a past event, which we control. So asset is something that you can control. That's very important. So something that you control, which will lead to inflow of economic resources. Maybe today it is not generating money, but tomorrow, or it has the capability to generate money for you. That's an asset. We don't have the concept of probability now. So if what can be the question out of this? In SBR's perspective, what could be the question? Simple question. That many standards till date, like IFRS 5, they talk about caption criteria, right? Where we talk about probability of selling the asset. Many standards like IS 38, when we say intangible asset, we still talk about probability. IS 37, provisions, liability, we still talk about probability. So when probability is still there in those standards, but it was removed from conceptual framework, then how is it aligning? How is conceptual framework aligning to the standards? That's something we should think about. So there is a conflict, right? And if there is a conflict, then of course, guys, who is going to win? CF versus IFRS. It is always the IFRS which wins. The rule wins, not the principle behind the rule. Principle behind the rule sometimes might be tarnished. It's still okay. But what wins is IFRS because rule is a rule. So as per rules till date, we are using probability in various standards. But yes, that means there is a scope of change. In future, previously we used to talk about probability, but now we don't talk about it. Similarly, it does not align with IS 37, where we actually, we actually consider the provisions being recorded on the basis of We actually consider the provisions on the basis of whether the probability criteria is met or not. So this is what we have to keep in mind. Then what is income? What is income? Uh, can you guys hear me? Am I audible? Am I audible? Yeah, okay. It's okay, right? Working? Yeah, let's get back. What is an income? Income is basically an increase. Income is basically an increase in liability. Okay. Increase in equity, not liability. Increase in equity. Income is all things positive. Increase in equity, increase in asset, or a decrease in liability. That's what income is. That's what income is. What is an expense? Expense is all things bad. How all things bad? For example, decrease in asset, increase in liability, decrease in equity. This is what I mean by an expense. Now, you might say, ma'am, that is so basic. Why are we covering this one day before the exam or few days before the exam? The point is that this can be asked in the question also. Margi company has asked you a question on it. They have related this definition of income and expense with that of IFRS 2. So in IFRS 2, share-based payment, what happens in share-based payment? What is your journal entry? Expense, debit, equity, credit. So in equity settled share-based payment, your journal entry is expense, debit, and equity, credit, right? So when I pass this journal entry, does it meet the definition of expense here? Equity is increasing because of the expense. Isn't that non-aligning with the definition of expense? I just said that expense leads to decrease in equity. But when I talk about share-based payment, IFRS 2, the journal entry says something else. It is expense, debit, and equity, credit. Equity is increasing. So that is not aligning with the conceptual framework. So can I say that share-based payment is a wrong standard? It's a wrong rule that has been made? No. I will have to find a way out. I can't just say that this is incorrect standard. Yes, there is non-alignment, there is inconsistency, right? There is an inconsistency, of course, but it is still good to go with. So here also the CF is not equal to the standard, but ultimately IFRS wins. But I can still give some logic that how IFRS 2 is still abiding with the definition of an expense. What could be the logic? When I'm saying that expense, debit, equity, credit, I am talking about share-based payment made to my employees, correct? Now, these employees are your human resources. They are your human resources. So what logic we have seen in Margi company, if you have read the answer to Margi company, they have said, they've given very lame logic that human resource is an asset. Now, because we are paying salary to them, that means we have used them. So that's just like an asset is being used. So asset is being used, which is why when we pay salary to them in terms of shares, we can say it's our expense. We don't relate it with equity. Equity, let's keep it separate for a moment. But because when we pay salaries to our employees, it's basically like we are using our human resource. That's like a decrease in asset, use of asset. That's why it's an expense. That's the logic we have seen in Margi company, right? Where IFRS 2 has been related to conceptual framework. So you should remember these logics. This is what you might have to come up in the paper. The paper can have a bouncer question. You might not have seen it before, but still try to come up with some logic. And even if you don't, you know that if the CF is inconsistent with the IFRS will still win. So just know that. Okay. So that is the definition of expense. Then what is equity? Equity is simple. It's the residual interest in net assets of a company. Residual interest in the net assets of a company is what I mean by equity. So equity is basically when I have shares in any company. So shares of that company is equity. The retained earnings of the company is equity. There are the components of equity is also equity. So all assets minus liability, that is the capital, is termed as equity, right? All the assets minus the liability is termed as equity. Okay, so that's the definitions. Now let's talk about, like I said, if I have a school and I want to make rules for the school, we talked about what I want to imbibe in the students. Similarly, how should we make the financial statements? What are the qualities of financial statements which ISB wants to be there, due to which they have made certain rules? The first and the primary qualities are that the financial statement must be relevant. What do you mean by relevant? That they should have everything that is material. Now, material means that you should not misstate something, okay, which can affect the decision of the users. Who are the users of financial statements? People, investors who are putting money into your company, the bank who's giving loan to you. All these are users of financial statements. So if you want to invest in any company, you look at their financial statements. If you want to give loan to them, you look at the financial statements. So all these people are users. Now, if a person is making a decision based on financial statements, there should be no such misstatement in the financial statements which will impact their decision. So that's how you decide whether something is material or not. So there should be no misstatement. There should be no omission. Omission means that you totally forgot to include something. Misstatement is that you misstated it. That means there was a mistake. There was some incorrect information. Omission is that you've completely forgotten to record that information. Third is new thing that was added, obscurement. Now, what do you mean by obscurement? That you're trying to hide something. So, for example, if a company has made a loss in an investment, let's suppose I clutter the financial statement so much that people are not able to concentrate on that investment that I want to hide, or I put that loss on investment in OCI, because I know that the investor will first look at P&L. Nobody is going to look at OCI. So let me just hide this loss in OCI. Maybe I can go for that approach. Now, in that case, that means I'm trying to obscure or hide some material information. So that is basically when you're trying to hide a material information. So that also makes your financial statements irrelevant. So relevance is including everything that is material. Second is faithful representation. Faithful representation. What do you mean by faithful representation? Come on in the chat box. All my students, how do you know that whether the financial statements are faithfully represented or not? How do you come to know about that? Come on. Yes. Faithful representation. Complete. So basically CNF. CNF. Complete, neutral, free from error. So guys, whenever we are stuck in any situation, okay, in accounting, we refer to conceptual framework. Now, conceptual framework says that your financial statement should be relevant and they should be faithfully represented. So if I am stuck in any situation, I should take this as a guiding light. So if let's suppose I'm talking about cryptocurrency, whether cryptocurrency is a, it's a digital asset, it's an intangible asset, or it's a financial instrument, or it is cash. There is a debate on it, right? So what is cryptocurrency basically? For that, I will refer to conceptual framework. So conceptual framework says record it if it gives you relevant and faithful representation. So whenever you're stuck in something in accounting, you refer to conceptual framework. Okay, that's your go-to place. Also, faithful representation talks about another thing, that is substance over form. What is substance over form? Substance, I'm talking about economic substance. And form, I'm talking about legal form. So guys, in accounting, we go for substance over form. Legally, that particular transaction might be a sale. But still we say, look at IFRS 15, whether the sale criteria is met or not. Example, ma'am, IFRS 16, sale and lease back. You actually sell your asset and then you take it back on rent. All that is legally a sale and renting back criteria. But still we say in sale and lease back, refer to IFRS 15 whether the sale criteria has met or not. And then also you have two bifurcations, whether it is a sale or not a sale. So you go for economic substance. You don't go for legality. Legally, it might be a sale, but is it a sale economically? For that, you need to see the indicators of control, whether the control has been transferred or not, right? So this is what we consider as faithful representation. So these are the two primary qualities that you have to always remember, and that will help you a lot whenever you're stuck in a bouncer question where they're asking you to relate CF with any other standard. Make sure if you know nothing, at least write these two qualities. Try to build on them. Try to say that how that particular standard is meeting these two criteria. Okay. Then let's talk about some secondary qualities as well. Secondary qualities. What are the secondary qualities? That the financial statements should be comparable. That means you should apply the economic policies, the accounting policies consistently. That's why, in the IS 8, if you ask me, in IS 8, when we say whenever we change the accounting policy, the effect is retrospective. Why is the effect retrospective? Because you have to maintain comparability. You can't just like randomly change policies whenever you start with a new year. That's not possible. That's why we make retrospective changes. And accounting policies are changes, policy changes are only made if it is required by standard or it is like deemed necessary. It's very necessary that you should make these changes. Either it is required by the standard or there's a change of use of the asset, basically. Then only you make the changes in policies. Why do you do so? Why there are so strict rules around policies? Because you have to make the financial statements which are comparable. So are you seeing how we are relating conceptual framework to the standard? Then second quality is timely. The financial statements must be prepared timely. Now, if an year has passed and I make financial statements 5 years later, nobody is going to care about those financial statements. That is like logicless, that is senseless. Nobody needs those financial statements. So financial statements must be prepared on time for that particular period. That's why we just have like 6 months max in which we have to issue our financial statements. Then we have understandability. Now, what do you mean by understandable? I should make the financial statements which should be understandable to a person who has not done accounting, an engineer, a doctor, a lawyer. They should also be able to read the financial statements. It should not be too technical, too difficult to crack, like you are using very different terminology, too much of accounting terminology. That will make them non-understandable, right? Too much cluttered information, that will also make it non-understandable. Then you have verifiability. So verifiability is basically I should be able to trace whatever I've recorded in my financial statements. I can vouch it back to its source document. I can trace it to its source document. No dummy entry, no ghost employees, nothing recorded without a source document. Then only they will become verifiable. Then only they'll become reliable, right? So this is what we have as our qualities of financial statements and what is given to us in conceptual framework. So in 2018, two changes have happened. The word economic resource has been introduced. So previously we used to use economic benefit. Now we use a wider term, economic resource, and probability as a concept has been removed from the definition of asset and liability. That's the change that happened in CF in 2018. Are we all clear on conceptual framework and its application with various standards? Are we all clear on it? Can I get a confirmation in the chat box? Come on, quick. Are we clear on this? All of us? That's great. I want energy. Come on. Let's move on. Let's talk about non-current assets. Now, what is this non-current asset? See, non-current word in its term means an asset that I can keep for more than 1 year. More than 1 year. But there are various kinds of assets. Assets which are tangible, assets which are intangible, right? Assets which are tangible and assets which are intangible. So I have two kinds of assets here. Tangible assets and intangible assets. So on them, we have various standards. We have various standards on them, right? So now let's look at the standards which are very important for our paper. So you would see that certain questions in your exam kit were only made from non-current assets. For example, there was this question. I was just looking at one of your past papers. I hope you can see it on the screen. So this question in December 2025 paper, Arundel Company. If you see that it is made up of completely the non-current assets. So here they asked you about using Exhibit 1 and in accordance with IFRS, explain supporting calculations, the effect of factory closure. So we were talking about factory IS 16 and there was a closure. So we were talking about IFRS 5. Then we were talking about, I think IS 36 was also here. So we were talking about assets and liabilities of the oil palm. So there was some kind of an impairment and that has to be like allocated to the particular CGU. So there was a lot of thing happening around. There was a lot of thing happening around non-current assets, right? So let's discuss non-current asset because it's very important concept in SBR. Let's talk about IS 16, IS 38, and IS 40 all together. What do you mean by them? What is the basic difference between them? Let's discuss that. So IS 16, property, plant and equipment. IS 38, intangible asset. IS 40, investment property. Right? So IS 16 talks about any asset that is used in the process of manufacturing, anything that you use in administration, or an asset that you rent to others. That is basically what you mean by property, plant, and equipment. What is an intangible asset? Intangible asset is basically something that has, like, it's an identifiable asset. Identifiable means that it can be either be sold separately or it is arising out of a legal or contractual right. Also, it has no physical substance, and it is reliably measurable. That's when I record an intangible asset. No physical substance means that I can't touch it, I can't see it, I can't transfer it. It is not something which is like tangible. This pen is tangible, right? I can touch it. Then IS 40 investment property, what does that mean? It basically is for property that is lying idle, for capital appreciation, or for giving on rent to others. Now the point is rent point is here also and rent point is here also. So how do I differentiate between the two? So see, in IS 16, when you give on rent, we are talking about owner occupied property. We are talking about owner occupied property. Here we are talking about something which is given to third party. So you must have seen PGs. I don't know if you have seen this concept or not. Paying guest. Yes. Have you seen that concept? So basically the owner lives on the ground floor and maybe the owner is living on the ground floor and the tenant is living on the first or the second floor, right? So that is basically the concept of owner occupied property. So here I have to see whether I can separate the owner occupied floor from the rest of the floors or not. So let me give you an example. Let's suppose there is a 10 floor property. This is from a past paper, okay? There was let's suppose 1, 2, 3, 4 floors. And the owner is living on this floor, right? He's living on this one floor, and rest of the floors are rented out to third parties. Now, if I can separate, if it is economically possible that I can sell this floor separately and these floors separately, if the floor system works in that market, then I can say that this floor is IS 16 because it is owner occupied, and the rest of the floors are IS 40 investment property because they are occupied by third parties. Are you understanding my point? If I can economically separate this floor from the rest of the floors, then I can bifurcate. But if I cannot separate, then I will say the whole of the building is IS 16. So basically, owner occupied property is IS 16, and the property that you rent to third parties is investment property. Now, the point is, how do we measure them? Let's talk about their initial recognition of all the three standards. Initial recognition is same. IS 16 also we say recorded at purchase price. Okay. Add the directly attributable cost to it. What is directly attributable cost? Anything that is incurred to bring the asset to its current use. Right? So directly attributable cost, for example, if I buy an asset, I will pay its transport cost, right? To bring that asset to particular factory, to bring that asset or a washing machine. Let's suppose if I want to install a washing machine in my factory. So I will bring that washing machine to the factory. So the cost of transport is a directly attributable cost. Similarly, you have dismantling cost. So you create a provision for it. Dismantling cost is taken at present value and you create a provision for same. So you also add it into the cost of asset. Then you also have irrecoverable taxes. What are irrecoverable taxes? For example, I purchased a laptop. I pay GST or VAT on it, right? Now, let's suppose I am not registered for VAT or GST. Then I cannot claim that particular GST back. It is irrecoverable now. But if I was a business, I could have claimed it, right? I could have claimed it if I was a business. So irrecoverable taxes, if you pay tax but you can't take it back from the government in other form, then that's irrecoverable tax. Then borrowing cost, IS 23 borrowing cost. All of this is capitalized into the cost of the asset. That's the accounting treatment, which is same for three standards. What is the subsequent treatment? Subsequent treatment for IS 16, subsequent treatment, there are two subsequent treatments. One is cost model, another is revaluation model. For IS 38 also, you have cost model and you have revaluation model. For IS 40 investment property, you have cost model and you have fair value model. So you have two different models here, revaluation and fair value. Cost model is same in all the three situations. So many people even fail to understand that these are separate models. They think that the accounting treatment for all the three standards are exactly same. However, it's not the case. So what is cost model? Let's talk about cost model. Cost model is when you keep your asset at carrying amount. Ma'am, how do I keep my asset at carrying amount? Carrying amount is calculated as cost minus accumulated depreciation minus any impairment loss that has happened during the year. So that is basically your carrying amount. Then how do you record as per revaluation model? Revaluation model says that you have to take your asset to its fair value, take your assets to its fair value whenever the difference is substantive. What do you mean by this? See, whenever the difference is substantive means whenever the fair value versus the carrying amount difference is substantive, it is basically very high. That is when you take it to its fair value. That is when you revalue it. You just don't revalue it at each reporting date. That does not happen. You revalue it only when the difference between the carrying amount and the fair value during a given year is very substantive, very significant, right? And then the revaluation gain goes via other comprehensive income. So because this revaluation gain is going via other comprehensive income, if due to this revaluation, any deferred tax arises, any deferred tax implication arises, that also goes via OCI. So see, we are relating IS 16, IS 38 with deferred tax also, right? So you are on the revision phase. I hope you are aware about the deferred tax concept as well, even though we'll talk about it, but still. So here revaluation gain goes via OCI. Similarly, if there's a revaluation loss, then that first is taken via, first you take it out from revaluation surplus. What is the rule? That this surplus should be related to that particular asset only. So if there is a revaluation surplus which has previously been recorded related to that particular asset, first I will take out loss from there. Then the remaining loss will go via P&L. That's how you treat impairment also. That's exactly how you treat IS 36 impairment as well. So revaluation loss accounting entry and impairment accounting entry are similar, right? So this is how you record revaluation gain. So revaluation gain via OCI and revaluation loss via P&L. You should know that. Now, fair value model of investment property. How do I account for that? Fair value model of investment property. How do I account for that? Let's talk about it. Fair value model says that you should take the asset to its fair value at each reporting date. Not just whenever it is necessary, but at each reporting date strictly. And whether it's a gain on fair value or a loss on fair value, make sure that you take that gain or loss via P&L. Thirdly, you stop depreciating your asset. Why? See, when you're using the cost model, you still depreciate. But when you're using there. Okay. Is there a lag? Yes, guys. Is it visible now? Visible? Sure. Okay. So let me repeat the fair value model part for you. Let me repeat the fair value model part for you. So fair value model says that the asset is kept at fair value at each reporting date. So all the investment properties are taken to their fair value at each reporting date. And whatever the gain or loss happens, that goes via statement of profit and loss. Okay. So unlike revaluation, where the gain was going via OCI and the loss was going via P&L, here gain or a loss, it goes via statement of profit and loss. Then you stop depreciating the asset. Why? Because we are taking the asset to its fair value at each reporting date, and the gain or loss is already going to P&L. So what's the point of depreciation? If there will be any depreciation, any which ways, if there will be any depreciation, that will be. You are on mute. No, I'm not on mute. Am I audible to you? It's audible, right? Okay. So you have to stop depreciating it. So this is what fair value model is. Let's little quick it and move further. So what is the difference between revaluation model and fair value model? Revaluation model says that it will only be taken to fair value whenever the difference is substantive, whereas the fair value model says that you have to take it at each reporting date. The revaluation model says gain will go via OCI, and here the gain or loss both goes via P&L. Then revaluation model says loss will go via P&L, and here it says that we will also stop depreciating the investment property. Now, that is the basic difference between the three standards. Also, guys, one more difference is between the three standards about depreciation. Again, IS 16 talks about the concept of depreciation. IS 38 talks about the concept of amortization. And investment property talks about the concept of depreciation only. But that is only in the cost model, not the fair value model, right? Now, here, depreciation, you all know, can be calculated on the basis of straight line method or reducing balance method. So straight line method is when the life of the asset is given to you and you're supposed to depreciate it over the life of the asset. IS 38 talks about amortization in a different way. Let's talk about it. Amortization depends upon whether the intangible asset given in the question has a definite life or indefinite life. Now, how do you know whether the asset has a definite life or not? You have a question on it, core bill. We'll just look at this question in a moment, where we talk about definite life and indefinite life assets. If an intangible asset has definite life, then it is amortized. Then amortization is nothing but depreciation. But if the life of the intangible asset is indefinite, then we conduct annual impairment review as per IS 36. That's what the rule says. So let's now check out Corbel Company question. Okay, let's just have a look at Corbel Company. It's one of the questions we've done in classes as well. Yes. See, here what they are talking about in Corbel. We'll not solve the question as such, but we will just look at it. First of all, they're asking you, describe the main challenges in recognizing and measuring intangible assets, such as brands in statement of financial position. 5 marks for this. So, intangible assets such as brands. Why is it a challenge to record and measure them? Because, guys, brand's life is very difficult to estimate. Brand's value is not a reliable measure, right? Also, if you know, if you have an internally generated brand, that is not recorded in individual accounts, but it is recorded upon consolidation, right? So that means if a company, why do we not record internally generated brands? Because it is very difficult to fair value it. It is very difficult to find its cost. How do you know whether you have a brand value or not? So that is something which is difficult to recognize and measure. So here you will talk about its measurability, uncertainty in measurability. Then you'll talk about that in recording brands might not give a relevant and faithful representation. That's why in individual financial statements we don't record it. And over and above, it's very difficult to ascertain the life of the brand. Sometimes the life of the brand is associated with a person. I don't know if that person will die tomorrow or he will live for long, maybe 100 years. So I don't know that. That's such an uncertain thing. So how do we know that what the life of the asset is? So that was one question related to IS 38. Further, they talked about whether the Jangi company brand name will be accounted for separately from goodwill on acquisition, whether it should be accounted for as a separate CGU after the integration of the manufacturing unit. Then how to account for intangible asset with an indefinite life. So guys, we conduct annual impairment review when an asset has indefinite life, and whether Locust and Clara perfume can be regarded as having an indefinite life. So let us look at Locust and Clara perfume brand. Let's look at them. For that, we'll have to first read the background of the question. Then we can tell them whether the asset has the definite life or indefinite life. So Corbel trades in the perfume sector. It has recently acquired a company for its brand Jengi, purchased 2 additional brand names, and has announced plans to close its Italian stores. Corbel also opened a new store on a prime site in Paris. The financial year end is 31st December 2017. Now let us look at Locust and Clara perfume. Let's look at Locust and Clara perfume. Here, in addition to owning Jengi company brand, which it already has, Corbel has acquired two other perfume brand names to prevent rival companies from acquiring them. The first perfume, Locust, has been sold successfully for many years and has an established market. Locust has been sold for many years and has an established market. The second is a new perfume, which has been named after a famous actor, Clara, who intends to promote the product. The directors of Corbel believe that two perfume brand names have an indefinite life. Now, what do you think? Both Locust and Clara have definite or indefinite life? Yes? What do you think? See here, Locust brand name is something that we are using since many years. So you can say we can't predict that on what basis we decide whether we have this brand, with us or not. So this can be said that it has indefinite useful life. We don't know what will be the life of Locust brand. But Clara is based on the name of an actor. And this actor has life. Not just that he will die, but also his, fame will reduce. There will be reduction in the fame also, reputation of the actor. So maybe he will become irrelevant and so will his brand name. So therefore, Clara has a definite life. Clara has a definite life and Locust has an indefinite life. So this is how you're supposed to apply this concept. And if something has an indefinite life, you have to conduct annual impairment review as per IS 36. Right? Okay. Then we also have a concept of research and development. Research and development. So we have a lot of past papers on this. You can check out and you must have seen it in your studies also. Research and development basically is a difference between two types of expenses. Development expense is there if Pirate criteria is met. What do you mean by Pirate criteria? Pirate means that there is going to be a probable inflow, economic resources will inflow, economic benefit will inflow, and there is an intention to complete the development. It's not that you have started with the development, but you will not complete it. You have enough resources to complete that particular development. Then you have the ability to sell or use whatever you have developed. See, whatever you develop, you are supposed to either sell it or use it for your own self. So there should be an ability to do so. Then you should have a technical feasibility. Technical feasibility to do so as well. And you should be able to reliably estimate it. Reliably estimate it. So these criteria must be met before labeling any expense as development expense. Otherwise, it's a research cost. So research cost, guys, is expensed in statement of profit and loss. Development cost is capitalized in the statement of financial position. Right? This is what we have as research and development in IS 38. Then further we have standard, which is from non-current assets, a very important standard from AAA perspective also, IFRS 5. IFRS 5, that is on non-current assets held for sale. Non-current assets held for sale. Let's look at this standard. You might be holding some assets, group of assets, or operation. that you want to discontinue or you want to stop. Now that can be, for example, I want to stop an operation and 1 year later. So 1 year before, I can actually classify it as held for sale. So how can I do that? For that, I need to see whether the caption criteria is met or not. What is caption? There is a commitment to sell. Commitment to sell. There is an active plan to sell. There's an active plan to sell. There will be a sale in the present condition. Okay, the sale will be in present condition. Sale is probable. Sale is probable. It will happen within 1 year and there will be no change to the plan. There will be no change to the plan. This is what caption means. If there is a caption criteria being met, then only we hold it as held for sale asset. Otherwise, we don't. Right? Now, okay. Caption criteria is met, then what is the accounting treatment? What is the accounting treatment for any asset that is held for sale? The accounting treatment is that I have to take it to its lower of cost and net realizable value, or you can say fair value less cost to sell. That is basically impairment only. Why? Because if an asset has to be sold, it does not have a value in use. So clearly its NRV, its fair value less cost to sell, is its recoverable amount. So I'm taking the asset to lower of its carrying amount and recoverable amount. That is basically what impairment is. I have to stop depreciating that asset. I have to stop its depreciation because I am going to sell this asset. So I have to stop using that asset also. Stop depreciating it. And then you have to classify it as a current asset because you're saying you're going to sell it within 1 year. So clearly it's no more a non-current asset, but a current asset. Now, if you are selling an operation, that is termed as discontinued operation. Discontinued operation. Why and how can you classify something as a discontinued operation? What is the, you can say, definition of discontinued operation? Any operation, guys, any operation that you're planning to discontinue, which is either a separate major line of business, separate major line of business, either due to its nature or due to its geography. For example, the nature of the business is such that I might have to, I can say that it is a separate operation. It's a different operation. Or it is the geography. Maybe I have a business in India and I have a business in Dubai. I have a business in US. So I can say that, okay, there is a, the business is separate on the basis of their location also. Or it is a subsidiary that you purchased with a view of reselling. With a view of reselling. If you buy a subsidiary with a view of reselling, that is basically also defined as discontinued operation on the day you buy it. Because you bought it with the intention of selling it only. You don't want to align with the subsidiary. You don't want to consolidate the subsidiary. You are purchasing it the view of reselling. So on the day you buy it, it becomes a discontinued operation. What is the accounting treatment for discontinued operation? Same as above. Same as above. Just one additional thing. What is that one additional thing? You have to give a separate disclosure, profit after tax from discontinued operation. Now, this is something which is also there in IFRS 18. Yes. So IFRS 18 has given you a separate statement of profit and loss format, right? You have a separate format for P&L, where in one of the activities we have profit from discontinued operation. So that profit after tax is classified under the section of discontinued operation. Rest everything is same. That I will keep it at lower of cost and NRV. I'll stop the depreciation. I'll classify all the assets as current assets. Now, in a case when you are selling a lot of assets together, but they are not a separate entity, they are not a separate major line of business, that is not a discontinued operation, then it is termed as disposal group. When basically you are selling you're selling group of assets together. So generally, if you're selling your subsidiary, let's suppose you're selling an unimportant subsidiary, which is insignificant, whose assets are not significant to us. Let's suppose I'm selling that. So in that case, first of all, is it a discontinued operation? It's a separate major line or not? I said it is insignificant. So it's not a separate major line of business. Second thing, did you purchase it with the view of reselling? No. You bought it for consolidation, you bought it for alignment, but later you decided that you want to sell it. So it is not a discontinued operation. Then what it is, I'm selling a lot of assets and liabilities together in one transaction. Then it is termed as disposal group. That's what IFRS 5 is all about. So whenever you're discontinuing anything, you need to refer to IFRS 5. Whenever they talk about closure, restructuring, they talk about selling an asset, that's what hints towards IFRS 5. Right? So when we were looking at this, one of the questions in the past papers I was talking about, here they have said Arundel stopped using the existing factory. It immediately advertised item of plant and equipment for sale at fair value. So here basically they're talking about selling the factory. So identification was a problem here. So whenever they talk about selling something, discontinuing something, that is basically IFRS 5. Right? Now let's move on to IS 36, impairment. Let's talk about IS 36. See, what is impairment? Impairment is when I'm taking my asset to lower off its carrying amount and recoverable amount. When I'm taking the asset to lower off carrying amount and recoverable amount. What is carrying amount? Cost minus depreciation minus previous impairment. What is recoverable amount? Ma'am, it is higher of value in use. Value in use is the present value of future cash flows. Yes, present value of future cash flows. And higher of fair value less cost to sell. Now, guys, this value in use, when we are calculating its present value, we are using a discounting factor. This discounting factor is generally the pre-tax market rate. This is a rule that we use pre-tax market interest rate. We don't use the interest rates given in the lease. We don't use the interest rate which are effective. For the present value calculation, the value in use calculation, we use pre-tax market interest rate. And when we are projecting what will be our cash flows from that particular asset, we have to assume either our growth rate is 0, or it is steady, or it is reducing, because that is how you practice prudence. This is an application of prudence, where we are saying that, okay, we are going to keep our discounting factor. We are going to also assume a growth rate which is either 0, steady, or it is reducing. So we are being prudent here. We are not over optimizing. We are not overthinking. We are not becoming over positive, right? So prudence is a shield against over optimism. Fair value less cost to sell. Fair value comes from IFRS 13, and cost to sell will mostly be given to you in the question. So this is how you actually calculate your recoverable amount. So you see the carrying amount, you see the recoverable amount, and you take the asset to lower of these two amounts. And whatever is the loss, just like revaluation downwards, you take the loss first via the revaluation surplus of that particular asset and the remaining to statement of profit and loss. That's it. So this is how you treat impairment. Now, impairment generally exists if there is an indicator of impairment, right? Now, indicator can either be internal or it can be an external indicator. So in the questions, you can find such case studies where they're asking you to identify the indicator. So whenever you see words like demand has decreased, increased competition, or you see words like the asset was lying idle, the receivables have not yet paid, maybe there is a recession going on. All of that indicates impairment, or there was a flood, or there was a natural disaster. So all of that indicates impairment. And then I have to conduct a review where I'm going to compare the carrying amount with the recoverable amount. And the recoverable amount is higher of value in use and fair value less cost to sell, where value in use is present value of future cash flows, where I use pre-tax market interest rate and a growth rate which is zero, steady, or reducing, right? So this is what impairment looks like. Then we have a concept of cash generating unit. Cash generating unit. CGU. Yes. So what happens in a CGU? It is a group of smallest identifiable assets. Identifiable assets which can be generating cash flows as a group. So independently, they generate cash flows as a group. For example, let's suppose you are staying in a hotel. So that hotel has its restaurant. That hotel has its bar. Okay. It has a swimming pool. It has the rooms where you will basically have guests coming in. So there will be rooms as well. So they have different CGUs. How can you decide? Let's suppose you want to impair a fan in the restaurant. How can you decide that how much money will that fan generate in future? How will you evaluate the value in use of that fan in the restaurant of that hotel? It's not possible, right? So that's why we make a CGU. We say that all the assets in the restaurant are one CGU because restaurant is making money independently. But goodwill of that particular hotel is allocated to every CGU because that is a corporate asset. Brand is also corporate asset, which is what is a corporate asset? Something which is omnipresent. Like we say, God is omnipresent. Similarly, goodwill of the company, goodwill of the hotel affects all the CGUs. It is omnipresent, right? So it's allocated to all CGUs. Now, when I'm impairing a CGU, guys, when I'm impairing a CGU, please pay attention. How do you allocate impairment to a CGU? The concept says that first allocation happens to the damaged asset. To the damaged asset. Second allocation happens to the goodwill. The whole of the goodwill wipes off to allocate the impairment to the CGU. Third allocation happens to other non-current assets on pro rata basis. Other non-current assets on pro rata basis. Correct? And how do you do this on the pro rata basis? You calculate the weight. For example, there is a CGU. Let's take a numerical example. We are talking about a restaurant. Let's talk about a restaurant. In that particular CGU, we have plant and machinery. Then we have land. Then we have goodwill. Then we have receivables. Let's suppose the carrying amount of plant and machinery was 100, land was 200, goodwill was 50, receivables were 30. So total carrying amount comes out to be 380, right? And let's suppose the recoverable amount in the question is coming out to be 300. And there is no damaged asset. So what is my impairment? My impairment is of $80 or $80 million if I'm working in millions. So I have $80 million impairment. How will I allocate? There is no damaged asset. So first I'll allocate the full impairment to goodwill. So goodwill will come out to be zero now. So first impairment happens to the goodwill because there was no damaged asset. Now I have to impair rest of the non-current assets on pro rata basis. I can't impair a receivable because it is a current asset. I said non-current asset. Why do you not impair Current assets, because receivables are impaired under IFRS 9, you have the concept of loss allowances there. You cannot impair it here. Further, if you talk about inventory, inventory is always already kept at lower of cost than NRV. So you can't further impair it. So what you will do is you will calculate the weight of these two. It is 300. So what is the weightage of plant and machinery? It is 100 out of 300. And I have to impair the remaining 30. So I'll allocate it using pro rata basis. Similarly here, 200. The weight is 200 out of 300 and I have to allocate 30. So this is how I come to know about pro rata basis. That is the allocation of impairment. Now, we will come back to this concept once more when we will talk about goodwill in group accounts. Because when we are impairing goodwill in group accounts, there is a concept of total notional goodwill. So we'll come to that concept when we come to group accounts. So that is IS 36 for you. Okay, so this was the whole non-current asset, okay, where I've covered IS 16, IS 38, IS 40, IFRS 5, and your IS 36, the main standards. Further, you also have small standards like IS 23 is there, borrowing cost. So IS 23 talks about qualifying asset. So if there is a qualifying asset, that means something that takes a considerable time to come into being, something which takes time for construction. So that particular asset, okay, if you have taken loan for that asset and you are paying interest on that loan, if you're paying interest on that loan, then this interest can be capitalized in the process of construction of that particular asset. That is the concept of borrowing cost, IS 23. Then you have government grants, IS 20, where you have two types of grants, revenue grant and capital grant. I'm not covering that topic because from SBR perspective, it is less relevant and it is kind of an assumed knowledge. And I don't think it requires our time here in the Grand Revision. So we have done the full non-current asset section and conceptual framework with the application part. Are we guys clear till here? I want a quick confirmation from all of you in the chat box. Are we all clear till here? Yes. Are we going good? Is the energy fine? Everything okay? Okay, so we have 230 people in the class, but only 50 likes. That's very bad. Come on. Are we all clear? Okay, awesome. Now let's talk about IFRS 13. Fair value measurement. Very important standard. Very important standard. Let's talk about it. Because generally, whenever I talk about fair value this, fair value that, from where the world am I getting this fair value? I'm getting it from IFRS 13. IFRS 13 first defines fair value for me. Fair value, they say, is an exit price. It's an exit price, okay? Exit price means that when I sell an asset, when I transfer a liability, whatever I money receive, whatever the money I receive is fair value. So fair value is the price that you receive when you sell an asset, transfer a liability or sell an asset in active market, uh, on the measurement date, and that is a transaction that is happening at arm's length. That means it's not a forced transaction. So something that is happening naturally, which is happening with the commercial acumen. We are not talking about someone who's doing charity. We are not talking about someone, we are talking about market participants who are at arm's length. So this is a transaction between market participants who are at arm's length. That means they are not doing it for charity. They are not doing it for favor. They are not doing it in friendship. They are not doing it when they are forced. For example, when are you forced? Like COVID happened. Many people had to sell their businesses in the process of COVID. Now, that was a forced closure due to external factors. So, at that point, what was the price of the property was not the real fair value. People were actually waiting for COVID to pass by to get to know their actual fair value, because that was a very absurd situation that happened for the first time in years. So in that case, we can say it was not at arm's length. Whatever transactions that happened, they were forced transactions, right? They were not done with a commercial acumen. So this is what I mean by fair value. Now I get my fair value from markets. Market can be active market. Generally, what is an active market? The market which has highest amount, or there is a frequent transactions happening for buying and selling particular asset. Frequent transactions are happening. That is what I mean by active market. Now, if active market is unavailable, then I can also go for inactive markets. Now, these inactive markets are coming from level 2 input. When I look for, I'll talk about level 2 input, but basically if active market is unavailable, I can also go to inactive market as per IFRS 13. Further, in active markets also, there can be so many active markets. How do I decide which market to choose? First, I will pick up the principal market. What is the principal market? The market where there is highest amount of transaction, highest amount of transaction. But what if I can't count these transactions? What if all the markets have equal number of transactions? Then I will go for most advantageous market. How do I know about most advantageous market? Now that is where I maximize my fair value. How do you know how much value are you generating out of the particular market? You take the fair value, you deduct the transaction cost from it, and you deduct the transport cost from it. So then you come to know which market is most advantageous. And once you have determined the most advantageous market, you take out the fair value from there, and that becomes your fair value from the most advantageous market. But when you're calculating fair value, you do not take into account the transaction cost, because transaction cost is the feature of the market, not the asset. Now, let me show you a question, a T-value on this, in fact, that was there in your study text of SBR. Let me show you the study text. See, what is the definition of fair value? Price that would be received to sell an asset or paid to transfer a liability in an orderly transaction. Orderly transaction means arm's length between market participants at the measurement date. That's what we have considered. Now come to the TYU that I'm talking about. This one. See, let's have a look at it. What is the fair value of the asset? Now, TYUs does not mean something small. This is coming from past papers only. There was a question which was similar to this, which was tested in Mehran also. Or there was this question where IFRS 13 was tested at large. So what is the fair value of the asset if market 1 is the principal market for the asset? An asset is sold in two different active market at different prices. An entity enters into transactions in both markets and can access the price in those markets for the asset at the measurement date. What is the price? In market 1, price is 26. Transaction cost is 3. Transport cost is 2. Transport cost is 2 here as well. So what if market 1 is the principal market? Then my fair value will be 26 minus 2. That is 24. Because when I'm calculating the fair value, I do not take into account transaction cost. Because transaction cost is a platform cost. It's a market cost. If you're buying something from Amazon or if you're buying something from Flipkart, they will have different transaction cost. That might help you decide from which platform you're going to buy that product, but that will not impact the fair value of the product, because you will say that is Amazon cost, that is Flipkart cost, that is not the cost of the product that I've ordered, but the transport cost you'll include in it. So 24 will be the fair value, 26 minus the transport cost. What if there is no principal market? Then, ma'am, we have to find most advantageous market. We are supposed to find most advantageous market. How do I know which is the most advantageous market? So where am I maximizing my interest? Net price received reflects that what amount of money you will receive in both markets. Here you're receiving 21, here you're receiving 22. So clearly market 2 becomes most advantageous market. So what is the fair value if market 2 is taken into account? 25 minus the transport cost, that is 23. So this is the concept of most advantageous market, where you should know that when calculating, when fair value, you can note it down if you want to, is calculated, transaction cost is not deducted, because this is a sign of because it is a feature of market and not the asset. Right? This is the concept of most advantageous market. Now there's a concept of levels of input. So let's suppose you know that, okay, what is the principal market or most advantageous market? Sometimes there are no active markets available. So we have the hierarchy concept of levels of input. So you can take the fair value from level 1, where you take, you use the identical assets and you check that what is their fair value or their quoted price in active markets, right? You look at identical assets and their quoted price in the active markets. Level 2 input is when you look at similar assets fair value in the quoted price in active markets, or identical asset quoted price in less active market. So now what is reliable? It is better you get your fair value from level 1 only. It is not better to get it from level 2. But what if level 1 is unavailable? That's when, unfortunately, I'll have to go to level 2. What if level 2 is also not available? Then I can go to level 3, where I talk about unobservable inputs. Unobservable inputs. For example, I calculate stuff like, I calculate value in use, I project. Here I also talk about one more thing. I talk about observable inputs, which are not prices. For example, interest rates, yield rates, but they are very rare to see. So this is kind of a, you can say, ignorable point. But level 3 input, this is what management manipulates, because level 3 input is unobservable. You can't see it, you can't verify it. So management says, I don't have level 1 or level 2 input. So I directly went for level 3 to calculate the fair value of my asset. And this is what it is coming out to be. Right? So they value it in-house. So they can manipulate the results as much as they want to. Now, we also talk about fair value of non-financial assets. Fair value of non-financial assets. Let's talk about that. They say non-financial assets like property, like, plant, equipment, All these are non-financial assets. They are not financial instruments. They are not financial assets. So they're non-financial assets. How do you calculate their fair value? Their fair value is based on where you can maximize the value. Where you can maximize the value. So let us look at this. See, the fair value of a non-financial asset should be based on its highest and best use. Highest and best use comes from the market perspective. Okay, it comes from market perspective. It does not come from entity perspective. Some companies will say, I don't want to use my asset for this particular purpose. So that means this is not highest and best use. It does not matter what your intention or what your plan is. What matters is, from a market perspective, what is the highest and best use? And that highest and best use must be physically possible, legally permissible, and financially feasible. And maybe you have not yet received the permission, but if there is a probability that you can receive the permission, if that thing is not prohibited, then we assume that it is legally permissible. If someone has not said that here this thing is restricted, that means it may be allowed. Maybe I need a permission. So we say it is legally permissible, right? So there is a question, in fact, Mehran company. Let me show you that question in your SBR study exam kit. So let's look at Mehran. Here. Let's look at it. Mehran is a public limited company. It operates in a number of business sectors, okay, including farming, mining, and retail. The directors require advice about how to apply IFRS 13 over here. Mehran has just acquired a company which comprises a farming and mining business. Mehran wishes advice on how to fair value some of the assets acquired. One of such asset is a piece of land. Okay, there's a piece of land which is currently used for farming. So current use is farming, and land is a non-financial asset, by the way. The fair value of the land used for farming is 5 million. But if the land is used for farming purposes, a tax credit of 0.1 million arises. Tax credit is a positive thing. That means you're going to get back this money. So the fair value becomes 5 plus 0.1, the benefit that I'm getting, 5.1. Now, Mehran has determined that market participants would consider that the land could have an alternative use. Market participants, people out there, market participants, they say they can be using the same land or a similar land for residential purpose also. So the fair value of the land for residential purpose before associated cost is thought to be $7.4 million. So if I use it for residential purpose, the fair value will be 7.4. Clearly, it seems to be higher than 5.1. So maybe I can say that residential use is highest and best use. But in order to transform the land from farming to residential, there will be a legal cost of 200,000. So I need to deduct that cost. Legal cost means I have not yet got the permission, but I can get it if I want to. So I will deduct 0.2 from here. A viability analysis cost of 300,000. Viability analysis cost is basically whether it's a viable option or not. So we will deduct that. And cost of demolition of the farm buildings of 100,000. Again, that's a cost of conversion. I need to deduct that also. Additionally, the permission for residential use has not been formally given. And because of this, market participants have indicated that the fair value of the land after the above cost will be discounted by 20% because of the risk of not obtaining the planning permission. So what is the total coming out? I am basically deducting 7.4 minus 0.6. What is the total? Come on in the chat box. 7.4 minus 0.6. So that comes out to be 6.8. It is still higher than 5.1. But then they're saying to convert it from farming to residential use, I need a permission. So for that, I have to discount it by 20%. So I can only assume 80% as the cost. That is 5.44. Now that is still higher than 5.1. So what is my highest and best use? My highest and best use is residential use, and the fair value is 5.44 million. Correct? So we are not taking into account our personal interest, whether we want to do farming on this. We are taking the market perspective. So in addition, now that comes to a different perspective. So this is what I have made you understood, that how do you fair value the non-financial asset? You look basically at highest and best use, and that highest and best use is from market participants, not your individual perspective. And then you also look at whether that use is physically possible, financially feasible, and legally permissible. That's it. This is what we have from IFRS 13 perspective that you should be aware about. Okay. Now let's move on to another standard, that is IFRS 15. IFRS 15. Revenue from contracts with customers. See, in revenue from contracts with customers, we have 5 steps. Step number 1, we are supposed to identify a contract. Yes. How do you know whether a contract exists or not? A contract can exist basically if there are rights and obligation. If there are rights and obligations. So basically, both the parties have realized their rights and obligations, and they know that, yes, there is a contract existing between us. The payment terms have been identified. There's a probability that you will make the payment, and the contract has a commercial substance. That's when you identify a contract. Second is, you also look at separate performance obligations. Separate performance obligations within that contract. So you basically look at separate performance obligations within that contract. So now, how do I look at it? There can be separate performance obligations, but how? I can be within one contract giving various services. Whether they are distinct or not, I have to determine it. How do you know whether a service is distinct or not? See, if a company is selling that service separately and the customer is also ready to buy those services separately, that's when we know that it is distinct, that the customer is demanding them separately and the companies are also selling it separately. That's when we know that the services are distinct. Okay, so the case study can be about separate performance obligations. Okay, then third is to determine transaction price. How do you determine the transaction price? You basically look at various things. You look at the, for transaction price, you can look at stuff like variable consideration, variable consideration. Okay. You can look at a payment which is non-cash consideration. Variable consideration, basically, if I am going to get money on the basis of my performance, on the basis of various factors, then I'll say, what is the probability? What is the most expected amount that I will receive? Okay, that is how I will record my transaction price. Non-cash consideration, let's suppose there is a barter system happening. So what I do is I check that what is the fair value of good or service received. What is the fair value of good or service received? I take that into account. If that is unavailable, then I take fair value of goods or services granted. Goods or services granted, right? This is what I mean by transaction price, non-cash consideration. Similarly, if there is a cash payable to customer, what is cash payable to customer? What if I have to give money to my own customer? So that might be a discount, so it might be deducted from the transaction price. But let's suppose the customer is also a supplier. Let's suppose I have a grocery store and in front of me there's a restaurant. So the restaurant buys grocery from me and I buy my lunch from the restaurant. So in that case, I will pay the restaurant separately because it's a supplier to me, and the restaurant will pay me separately because I have given grocery to them. So this is how it works. Okay, cash payable to customer. Then significant financing component. If there is a significant financing component, that means you'll receive money like more than 1 year later from the due date. So that means you have to calculate the present value and then accordingly record the revenue and the receivable. Okay, so that is step number 3. Then step number 4 is allocation of transaction price. Allocation of transaction price to various performance obligations. How do you allocate it? Come on. How do you allocate it? You have to see, there are separate performance obligations. Let's suppose there are 3 separate performance obligations. I have to first of all take the pre-tax transaction price, that means excluding GST or VAT. And then I have to allocate it to separate performance obligations on the basis of pro rata. Just like we allocated the impairment to the CGU, same way I have to do it on pro rata basis. But before I do it on pro rata, I need their stand-alone selling prices. I need their standalone selling prices, right? Then only I can allocate to the various separate performance obligation. On this, you have a question, which is not something that I should pay time in the grand revision, but you can check after the class, ZTech. ZTech is a question related to allocation of transaction price. Then we have 5th step, that is recognition of revenue. Recognition of revenue. Now, revenue can be recorded at a point in time or over the period of time. When do you record the revenue over at the point in time? Whenever it is not OTP. So when is it OTP? When is it over the period of time? It is over the period of time when, okay, the revenue is recorded over the period of time if, how do you record it? If the customer simultaneously receives and consumes the benefit. If the customer is simultaneously receiving and consuming the benefit, that's when I record the revenue over the period of time. For example, I am teaching you guys. So you guys are receiving the services and you're consuming. Can I take back what I have already taught you? Not possible. So I'll record the revenue for the student who registered over the period of time, right? Then what else? Second is, if an entity is creating or enhancing an asset controlled by the customer, and there is an enforceable right to payment. So let's suppose I am a construction company. There's a piece of land owned by the customer and I am building a building over it. Okay, I'm constructing a building over it. Now, let's suppose one day the person has a mood swing and he says, oh, I don't want you as my construction company. Bye-bye. Now, that does not mean that they will not pay us on the basis of what work we have already completed, right? So for that, I must have signed a contract with them that I am bound to receive money on the basis of whatever work I have completed so far. right? So there should be an enforceable right to payment and creating and enhancing an asset controlled by the customer. So that is when I record revenue over the period of time. Then similarly, if you are creating or enhancing an asset, but this time you are controlling the asset, controlled by entity, but it has no alternative use to the entity. Basically, customized asset. If someone has got their product customized from me, I cannot sell it to other people. So for me, it is a sale. For me, it is something that I should get money for, right? So this is something that I will record over the period of time. So I will see how much work has been completed, and accordingly, I will record the revenue. So these are the 3 points. And if they are met, we record the revenue over the period of time. We record the revenue over the period of time. That's it. So this is what you should know from IFRS 15. There is also a concept of contract modification in revenue. So let's briefly discuss that also. Contract modification. So if already I have signed a contract with someone and they are modifying it, let's suppose they want more goods and services or they want less goods or services, whatever the case is. So this is contract modification. Now there are two situations. Either I will, I will terminate the existing contract and create a new contract, or I will add in the same contract, or I will have a separate contract. These are the only three things that I can do. If a contract is modified, either I can terminate the existing, create a new, or I can add the new products and services in the same contract, or I can create a separate contract for additional goods and services. Now, how do you decide? You decided on the basis whether the additional goods and services are distinct or not. See, if they are distinct, then I can terminate the existing contract and create a new one. If they are distinct, I can create a separate contract. But if they are same, if the goods and services are same, they are non-distinct, then I will keep it in the same contract only. I will not create any new. There is no hurdle in terminating the existing or creating a new contract. But how do I decide between this and this? Because here also the criteria is distinct, here also the criteria is distinct. This one is easy, that if the goods and services are non-distinct, then I can add in the same contract. But for this, I have to see the discount. Discount basically means I have to see that the new transaction price that I'm offering, is that below the fair value? Is that below the standalone selling price? Like, have I given some discounts? If I have given discounts, for example, you're studying SBR with me and you say, ma'am, I want to take AAA classes also from TG Professionals. So can you offer me a discount? So if I offer you that discount, let's suppose, so you get a discount on the basis of an existing contract. You are already having a contract for SBR. Now you added AAA into it. So now because you got a significant discount, let's suppose, so we will say that we will terminate the existing contract and create a new one, because the transaction price was changed because of the previous goods and services that I was providing. So that is terminate the existing one and create a new. But if I've not given you any special discount, no special discount, then what we say is that we will create a separate contract for the other additional services that we are providing. That's it. This is what we have from contract modification point of view in our IFRS 15 standard. You can check out questions like ZTech. I have given you the name ZTech. You can also check DigiWire. It's a combination. We have done that question multiple times. It's a combination of IFRS 9 and IFRS 15 as well, where we are talking about royalties, which are variable consideration basically. That's it. Are we guys clear till here? Now, the next standard that I'm going to start is leases, but we'll take a short break of 5 minutes before we continue with IFRS 16 leases. And then we'll move to IFRS 9, the most favorite standard of many people, and then group accounts. Okay, so let's take a break of 5 minutes and get back to the session. Have a cup of coffee or a glass of water, whichever helps. See you soon. Yes, guys, I hope I am audible to you. Let's further continue. Also, one topic from IFRS 15, which also requires your attention, is sale and repurchase. Let's discuss that as well. Sale and repurchase. So sale and repurchase is basically an arrangement where I sell something and then I also have a kind of an arrangement from the same person, the person who has bought that particular stuff from me, that I will take it back from you. I will repurchase it back from you, right? So what happens in sale and repurchase basically? When you sell something, when you sell something, you have either a forward contract to take it back or you have an option. Now, option can be call option or it can be a put option. What does this mean? Forward means that there is an obligation that if I have sold something, I will have to buy it back. Now, if there is such an obligation, how can you say it is a sale? Then we will say it is not a sale. Okay, it is not a sale. In case of forward, it is not a sale. Then what do we have? We have a call option and a put option. Let's consider that. Call option. What happens in call option? I have sold something, okay? I have sold something and I can call for it back. I can call for it back anytime I want to. I have an option to do so. Again, it is not a sale. So it is not a sale for forward. It is not a sale for call. Then put option. Put option is the buyer can come from the front and say, take your particular good back. Take your asset back. I don't want it. Now, do you have an obligation to accept it or not? That's the question. So either there will be a put option, either there will be a put option with obligation, or there will be a put option without obligation. So with obligation or without obligation. Now, let's understand it. If the put option is with obligation, that the buyer comes and gives that particular product back to me, and I have an obligation to take it back, it is not a sale. Because again, you're going to take it back any which ways. But if it is without obligation, that the buyer can return, that's basically a right to return. This is nothing else but a right to return. Then it is a sale. I will just calculate that what is the probability whether the person is going to return to me or not. So this is a sale. So when it is a sale, you know how to record it as per IFRS 15. But what to do when if it is not a sale? Whenever it is not a sale, you are supposed to see that what is the repurchase price, because we are talking about sale and repurchase. So what is the repurchase price? If the repurchase price is greater than the original selling price, then it is treated as a loan. So basically, you sold something, you received money from anywhere, and you are going to anyway repurchase that asset back. So that is more like you're going to pay more than what you got. Selling price is what you got, repurchase price is what you will pay. So when you pay more from what you got, that happens in loan, where you pay a premium. So that's why that will be treated as a loan transaction. If the repurchase price is lesser than selling price, guys, can you hear me? Can you hear me now? Is it better? Okay, let's continue. So ROU is any amount paid initially. That means before the commencement of lease. For example, you pay a security deposit and plus the lease liability. Okay. Now, what is the lease liability? Lease liability is present value of lease payments. Now, these lease payments can be fixed rentals that you pay. They can be variable rentals that you pay. So present value of all these, the rental payments that you're going to make for the amount of the tenure of the lease, that is lease liability. Then don't ask me to go back to a concept. You have an option. You have an option to the move back on the YouTube live, right? Okay, repurchase price. Let me just quickly revise this part with you. We were here at when it is not a sale. Were we there when it is not a sale? Yes or no? How do we account for it when it is not a sale? Okay. See, when the repurchase price is greater, than the selling price, that's basically like you are taking a loan because you have actually sold that particular asset and you have received money. So that means you are going to pay more than what you have received. So that's like a loan. The repurchase price is lesser than selling price. In that case, you are giving your asset to someone, but that's not a sale, but you are still receiving money. So that is like a rental agreement, right? So that is a lease. So this is how you treat when the sale and repurchase is not a sale. Okay. Then IFRS 16 leases, I was starting with it. So initially the lease is, we record an ROU, right of use asset, and a lease liability. ROU is any amount that is paid initially, okay, before you start the lease agreement. That can be a security deposit, plus the lease liability. What is the lease liability? Lease liability is present value of lease payments. Lease payments can be fixed lease payments or variable lease payments. Present value of these lease payments is what we say is lease liability. What is the discounting factor that you use when you calculate lease liability? You take interest rate implicit in lease. Now, if that is unavailable, then you use, what do you use? Incremental rate of borrowing. That what if instead of taking that particular asset on rent, I would have actually bought that asset on a loan, then what would have been my interest rate in that case? That's basically incremental rate of borrowing. So either we take interest rate implicit in lease, but if that is not available, we take incremental rate of borrowing. Then the subsequent treatment for lease liability is very simple. You are supposed to unwind the interest because guys, you know this, whenever in FR or in SBR, we calculate present value, we have to unwind the interest. We have to pass a journal entry where we say P&L debit and my lease liability credit for the unwinding of the interest. For ROU, I will depreciate it. How will I depreciate it? I will depreciate it on the basis of the life, the lease term, and the life of the asset. Whichever is shorter, on that I'm going to depreciate my ROE. Correct? This is the subsequent accounting treatment. Then there is a concept of sale and lease back. Very important. That's the most important one from leases. Sale and lease back. The sale and lease back means I sold something, then I have taken it back on rent. So what happens in that situation is the seller is basically The seller is basically the person who takes it back on rent. So he is the lessee. And the buyer to whom you sell that particular asset becomes the lessor. So what we do is, legally it is a sale. That's the legal form. But I am supposed to check its economic substance. So economic substance, we have to check from IFRS 15, whether it meets the definition of sale or not. Is it a sale or not a sale? That's what you have to check. As per IFRS 15, is it a sale or not a sale? So from the seller perspective, if let's suppose it meets the definition of sale, what will be the accounting treatment? Okay. So if it is a sale, seller will de-recognize the asset because he has made a sale. So you will de-recognize the asset, de-recognize asset, record receivable. That's basically like you will record the money that you're supposed to receive or the cash that you already received. So you'll de-recognize the asset and you will record the receivable. Then you will record ROU and lease liability. How will you calculate ROU in this case? How much of the asset have you retained? That will be calculated as present value over PV over FV into CA. So present value of lease payments divided by fair value of the asset into the carrying amount of the asset. That is the right that we have retained. Okay. And this will give us balancing figure, that is profit or loss on disposal. So you'll pass a journal entry where you'll say my asset is getting de-recognized. So bank debit because money comes in, asset credit because asset goes out, ROU debit because that's a right of use asset, lease liability credit. ROU will be calculated as PV over FV into CA, and the balancing figure in your journal entry will be profit or loss on disposal. Right? So this is how you basically, you know, this is how you basically do the stuff with sale and lease back when transfer is not a, when the transfer is a sale. What if transfer is not a sale? Then what happens? What will the seller do? Ma'am, seller will not de-recognize his asset. He will not de-recognize the asset. He will keep on recording it. He will not de-recognize the asset, but he has received money. So money is received. So that will be treated as a loan. If you receive money from anywhere just like that, that's a loan to you. And whatever rent you will pay, that will be interest on loan. Correct? What will the buyer do if it is a sale? If the buyer has purchased an asset, he will record the asset. Now he's the lessor in this case, so he will do his lesser accounting. What is lesser accounting? He have to bifurcate whether this is an operating lease or it is a finance lease. What is an operating lease? Operating lease is which is a short, not short term, but operating lease is a normal lease. Like for example, you've taken an apartment on rent for 1 year, 2 year, 3 year. That's an operating lease. But finance lease is, for example, you've taken something on rent for its whole life. That's basically you are going to own this asset. That's like a very long term lease. Okay. So that happens in many countries also, where you can't buy this, but you can hold it on lease. Okay, so that's a very long-term lease, like for 100 years, just like that. So there can be operating lease or finance lease. For operating lease, you record your income whenever it is due. You are going to receive rent whenever the rent is due, record it. For finance income, what you do is, for finance income, okay, you simply finance lease, you basically de-recognize the asset as a lessor because it's more like you have transferred your asset to the lessee. So we have to do normal lesser accounting from the buyer perspective if it is a sale. Now, if it is not a sale, for buyer, what it would be? If it is not a sale, it's like the buyer has given a loan. That's basically a financial asset from IFRS 9 perspective where they have given a loan. Okay. So whatever amount they receive, that is interest on loan. So this is what we have as sale and lease back. So let me show you one question related to it. Let me find that question. I think that was Rupul or Juan. Okay, here it is. Benito. Let's look at it. Now, this question involves sale and repurchase, and it involves sale and lease back together. Let's have a look at this question. Everyone on the screen. First, they've asked you general, it's a past paper question, so exam standard question, of course. Describe how the entity assesses whether transfer of an asset qualifies as a sale in sale and leaseback. So here you're going to talk about IFRS 15 control indicators. How do you know whether it's a sale or not? Whether the control has passed or not. That's what you check. Then explain how sale and leaseback transactions are dealt with by the seller lessee in accordance with IFRS 16 if it is a sale. So I've already given you in the table that we just prepared that what happens if it is a sale, if it qualifies as a sale, then how the they are talking about the seller slash lessee, how he treats it. Then explain if it is not a sale. I've also told you about that. Then explain the effect on the accounting treatment if a sale and leaseback contains a call option under which the seller and lessee can, at its option, repurchase the property. What does that mean? They are saying there is a call option. So when I talk about sale and leaseback, it's a very twisted question. When I talk about sale and leaseback, I say that I have to refer to IFRS 15 to check whether it is a sale or not. When I go to IFRS 15, then this concept of call option kicks in. Let's suppose there is a call option in the contract. If there is a call option, then we say that it is not a sale. So I will get this ultimatum that this is not a sale because of the call option. And then I will come back to IFRS 16 and apply the rules of sale and leaseback, not a sale. So basically, when I say refer to IFRS 15, I have to refer to full IFRS 15 to see whether it is a sale or not. So here they talked about call option. So that means if call option exists, it is not a sale. Right? Okay. Now, there is also concept in leases that what if transfer is above fair value? Transfer is above fair value. When it is a sale, I'm talking about the situation when it is a sale. What if the transfer is above fair value? So the extra amount is treated as the financial liability. Okay. And if the transfer is below fair value, then that lesser amount is treated as, when it is below fair value, then that lesser amount is treated as prepaid or prepayment. That's an asset. On that, we have a question, Mosaic. I always mention this question. So let me take you to Mosaic company. That's basically here in study text. It's a TYU, but it will help you understand a lot. Okay, this one, Mosaic. Let's have a look at it. Explain how the transaction will be accounted for on 1st January by both Mosaic and Ceramic. On 1st January 2011, Mosaic sells an item of machinery to Ceramic, okay, for 3 million. You have sold something for 3 million. Its fair value was 2.8. So clearly this is above fair value. So that extra amount is 0.2. So can I say this 0.2 is the financial liability? That's the financial liability. 3 minus 2.8. The asset had a carrying amount of 1.2 million prior to the sale. The sale represents satisfaction of performance obligation in accordance with IFRS 15. So basically, it is a sale. Mosaic enters into a contract for the right of use asset for next 5 years. Annual payments of 500,000 are due at the end of each year. Interest rate implicit in lease is 10%. The present value of annual lease payment is 1.9 million. So how will you calculate your ROU? ROU will be calculated as present value divided by fair value into carrying amount. Now, in this annual lease payment, they are saying 1.9 is the present value of future lease payments. Understand it very openly, okay, with an open mind. I am saying that Mosaic owes 0.2 million to Ceramic. That's why I've recorded financial liability of 0.2. And in future, Mosaic is going to pay 1.9 million in total to Ceramic. So can I assume that within this 1.9, this 0.2 is already there? Because it's a financial liability. So in future, whatever you're going to pay to Ceramic, that is where you will pay your liability also, no? So 0.2 is already part of 1.9. So what I can do is I can simply say that out of 1.9, 1.7 relates to the lease and 0.2 relates to financial liability. So what will be my ROU now? How will I calculate my ROU? PV over FV into CA. Present value of lease payments. So present value of lease payments is 1.7, not 1.9. Divided by fair value, that is 2.8. Carrying amount, that is already given to you in the question as 1.2. So you get a ROU of 0.73. So what is your journal entry now? Your journal entry is money comes in, bank debit 3 million, ROU debit 0.73 million. Okay. Then you have lease liability credit 1.7 million, financial liability credit 0.2 million, right? Now you see whether you also have an asset that you have to derecognize. So asset credit, how much? 1.2 million. Now you see whether the whether it is matching the, this is matching with this or not. There will be a balancing figure. What is the balancing figure coming out to be? What is the balancing figure coming out to be? That is your profit or loss on disposal. So this is 3.73. On the debit side, it is 3.73. On the credit side, it is 1.2. So 1.2, 1.7 plus 0.2. So that's 3.1. So on the credit side, there is a balancing figure. Balancing figure is of 0.63, right? So this is a profit on disposal. Profit on disposal as balancing figure of 0.63 million. So what you understood from this question was that how 0.2 was calculated simply as a difference between the fair value and the proceeds that we have received. And then we said that this financial liability is already part of the lease payments present value. And we bifurcated it that 1.7 million purely relates to leases, 0.2 relates to financial liability. Yes, are we clear on this? This is basically a very important question from sale and leaseback to understand how to deal with it when the transfer is above fair value. And this was also there in pre-mock March 2026 is what one of the students has said. So yeah, okay. Let's move on. So this is all about leases and sale and leaseback and sale and repurchase from IFRS 15. Now let's move to one of your favorite standards, IFRS 9. Financial instruments. Now the basics of financial instruments you guys have covered already in FR. But there is an additional stuff that we have in SBR. Okay. So let us understand from basics. I will be very quick with the basics because I want to cover more about advanced concept. So IFRS 9 says that we have financial assets and we have financial liabilities. Financial assets are debt instruments. That means when we give loan to someone. Equity instruments. That means when we buy share capital in that particular company. So we have debt instruments and equity instruments both. Okay. Now for the debt instruments, I basically have further two subsequent treatments. What are the subsequent treatments? Let's understand. So subsequent treatment for debt instrument. Either I can keep it under amortized cost, fair value through OCI, or fair value through P&L. For equity instrument, I can either keep it under fair value through P&L or fair value through OCI. Financial liability, I can either keep it at amortized cost method or I can keep it under fair value through profit and loss. These are the two methods that are available for financial liabilities. Now, let us make a quick note about these subsequent treatments one by one. So let me just open the Word and help you with some note. Okay. Yes. Let's talk about it. IFRS 9, financial instruments. So financial instruments all initially are recorded at fair value with transaction cost being capitalized unless the subsequent method was fair value through P&L, right? So we are going to capitalize the transaction cost unless the subsequent treatment that we have followed is fair value through P&L. Now, when we capitalize the transaction cost, we might add it or we might deduct it, because in financial liabilities, we deduct. So you can say in financial liabilities, to capitalize transaction cost means to deduct it. Correct? That is how you capitalize transaction cost in financial liabilities. Now let's come to further debt instruments. So debt instruments, that is a financial asset. So we have number one, subsequent accounting treatment of amortized cost. So amortized cost, when do we choose it? Fair value through OCI, when do we choose it? And fair value through P&L, when do we choose it? For that, we have two tests. First test is contractual cash flow test. That means I am going to get all the repayments in cash only. No benefit in kind. So I'm not going to get any benefit in kind. For example, if I talk about convertible debenture, for example, I talk about convertible debenture. So in convertible debenture, you have a choice to convert that debenture into a share. So that choice is a benefit in kind. So I cannot say that contractual cash flow test is met here. The second test that I have that has to be met is the business model test. So for contractual cash flow test, if the test is met, I can move to second test. If the test is failed, then without any delay, you have to treat it under fair value through profit and loss. So here, fair value through profit and loss is basically our dustbin. Wherever we feel like, okay, this is not met, we are going to put it in fair value through P&L. Now, in the business model test, what you have to see is intention. What is your intention for that particular asset? Are you going to keep it till maturity? Are you going to keep it till maturity? If yes, amortized cost method is used. Are you unsure about it? Like, is it like I can sell it also whenever favorable, whenever it is favorable to sell? So it's like an I don't know situation. Then you will keep it on fair value through OCI. If you are trading with it, if you're going to keep it for short term, then you're going to use fair value through profit and loss treatment. This is what you do for debt financial assets. Now, these debt financial assets, which are kept under amortized cost and fair value through OCI, only these can also be impaired. Yes, let's talk about impairment of financial assets. That's an SBR concept, not there in an FR. So, impairment of financial assets. So, which financial assets are impaired? Only the financial assets which, ma'am, are debt instrument kept under amortized cost or fair value through OCI can be impaired. Now, impairment means that I will have to create a loss allowance. That's more or less like provision on doubtful debt. Okay, that's more like a provision on doubtful debt. It is not bad debt. The other informal word that we use is provision on doubtful debt. Now, there are two types of loss allowances. Number one, there's a 12-month expected loss allowance. Then you have a lifetime expected loss allowance. 12-month expected loss allowance and lifetime expected. For receivables, you always take lifetime expected loss allowance. Why? Because life of receivables is anyway less than 12 months. So I am going to take their lifetime expected loss allowance because that would be anyway lower than 12 months. Then, how do we decide which loss allowance method to choose? That depends upon credit risk. What is credit risk? Risk of non-repayment of the you can say loan, that the person will not repay the loan to us. That is credit risk. If the credit risk has significantly increased, since the time you have recorded that asset till date, then we say we will create a lifetime expected loss allowance. How do you know? This is based on judgment. This is not something which is rule based. You will look at the case study. Okay, you're going to look at the case study and then decide whether the lifetime loss allowance is required or not. Then, if the credit risk has not significantly increased, then we are going to go for 12-month expected loss allowance, right? So this is how you decide that which loss allowance has to be created, 12-month or lifetime expected. It depends upon the credit risk, whether it has increased significantly or not increased significantly, right? Then further, when we are creating loss allowances on debt instruments kept under fair value through OCI, the IFRS 9 says, so IFRS 9 states that an asset cannot be taken to an amount lower than its fair value. That's a rule. And whenever we are doing loss allowance, the loss allowance loss, what is the journal entry for loss allowance? Statement of profit and loss debit, loss allowance credit. How do you calculate loss allowance? Loss allowance is calculated on the basis of present value of losses, basically what you expect versus contractual. So it is what do you expect versus what is there in the contract. So you take the present value of that losses and you also probability weigh it. So you do both the things and then you get the loss allowance. But when you are creating a loss allowance on an asset debt instrument kept under fair value through OCI, things change. Why? I'll take an example. Let's suppose there was a debt instrument with a fair value at initial date of $150 million. Then at reporting date, the fair value is $90 million. And further, this is kept under fair value through OCI as per the question. And they are saying that also create a loss allowance of $30 million. Or let's suppose $35 million. Now, what will you do? You cannot say that initially my asset, my debt instrument was 150. Now it is down to 90. So that means there is a loss of 60. There's a loss of 60 million. Now this 60 million, because it is kept under fair value through OCI, should go through OCI. But they're also asking to create a loss allowance of 35. I can't decrease this 90 further by 35. Because if I do so, I will breach this rule that an asset cannot be taken to an amount lower than its fair value. So the fair value is 90. I cannot further reduce it by 35, but I also need to create a loss allowance. So what I will do, guys, I will bifurcate this 60. I will say out of this 35 million is loss allowance, which will go via statement of profit and loss. And the remaining 25 million is the fair value loss, which will go via other comprehensive income, right? So 35 is a loss allowance, 25 will go via OCI. Now, this question has been asked in one of the past papers, and the question that you can check for it is Carsoon Company. So let me show you Carsoon Company. Let me just show you, okay? I'm not going to really solve it because I've done it and it's not that important, but I'm just showing you that how that concept has been tested. Here. See? So they're saying there has been a significant increase in credit risk and expected credit losses are measured to 12 months of 400,000, and Carsoon sold the debt instrument for 5.3. So basically there was a 500,000 fair value, you can say loss allowance that has to be created. And there was a fair value loss of 0.7. I'm already telling you this. You will read the question and you'll get to know that the total fair value loss was 0.7 and loss allowance to be created was 0.4. So since this was an asset kept under fair value through OCI, so we bifurcated the loss. We said out of 0.7, 0.4 is loss allowance and 0.3 will go via OCI. That was the answer to this question. So you can try this question after the class today, this first part of Carsoon. Okay. So moving back, on the bifurcation, we have discussed the impairment, the loss allowance. Then we have a concept of credit impairment. See, credit impairment is something that is equivalent to bad debt. Credit impairment is when counterparty has ensured that they will not be able to pay. They won't be able to pay due to any XYZ reasons. They have ensured that. So that is a credit impairment. That's more like a bad debt. They have come up that this is the reason why we are unable to pay and this is what the amount in total we can pay. So this is credit impairment. This is a loss that you immediately record in your statement of profit and loss. Now, in credit impairment, you will also have a situation when you might purchase an already credit impaired asset. So in that case, what do? You simply use CIAR. So if you have purchased or if you're given loan to someone whom you know will default, why would you do that? It happens, okay? It happens. So you can use, when you are calculating your amortized cost table, when you're making that opening asset plus interest minus the cash received is equal to closing asset, that interest, instead of effective rate of interest, you will use credit impairment adjusted rate. That's what happens when you buy an already impaired debt instrument. Okay. Then comes the concept of equity instrument. Let us discuss the concept of equity instrument. So in equity instrument, guys, we have two methods: fair value through P&L, which is like by default method. We opt for this. And then we have fair value through OCI. When do you choose fair value through OCI? When your instrument must not be held for trading. Okay, that's the number one rule. And the second rule is that you made an irrevocable choice upon designation. You made an irrevocable choice upon designation that we are going to use fair value through OCI for our debt instrument or for our equity instrument here. So you made an irrevocable choice upon designation. That means the day you bought it, you said, I'm going to use fair value through OCI. Okay. Then you have a concept of convertible debenture. What is there in convertible debenture? That's when you issue a debenture that can be converted into shares. I'm talking about issuing. Okay. So when you issue it, you have to do split accounting because part of it is related to financial liability and part of it is related to your equity. So part of it is equity, part of it is financial liability. It depends upon how do you calculate it. So because you are saying, I have issued the debentures, that means I have raised finance, but the counterparty can convert it into shares. So I might end up giving them my equity also. So financial liability is calculated as present value of future payments. So how much I'm going to pay in future, I calculate present value of it. For the present value calculation, guys, we use discounting factor, which is the rate of interest on similar debentures without conversion option. That's the rule. So I use similar debentures without the conversion option. Okay. And that's how we calculate present value of future payments. And the equity is proceeds minus the financial liability component. So basically the balancing figure that comes out to be equity. Then comes your concept of financial liability. Now, financial liability, what do you have? You have two methods. Number one, amortized cost. That's like a by default method that we have to use for liabilities. Then we have fair value through P&L. When do we use this fair value through P&L method? Whenever either we are holding that liability for trading or we want to avoid an accounting mismatch. Now, ma'am, what do you mean by this term accounting mismatch? Accounting mismatch basically means, for example, you purchased a property on loan and that was an investment property. So you have recorded that using fair value model. So all the gains and losses are going via P&L, but you have taken a loan and you recorded at cost. So some companies feel that that's absurd. That's like an accounting mismatch because the property and loan both were born together in the ledger together. So they become like related to each other. So how can you keep one at fair value and another at cost? So to avoid that accounting mismatch, sometimes we say that since the property is kept at fair value, let's keep the loan also at fair value. Correct? So this is what we have for fair value through profit and loss. Okay. Then in financial instruments, we have a concept of derivatives, SBR perspective. So derivatives, guys, basically three things should be met before you classify something as a derivative. Number one, it is something that will be settled at a future date. Settled at a future date. Then second thing is that we are going to, it will be settled at a future date. Its value is dependent. Its value is dependent on an underlying item. Okay, its value is dependent on an underlying item. And lastly, it has a zero. It has a zero or very less initial value. So for example, forward contracts, share options, all these things are derivatives. So in this case, how do you treat a derivative? How do we treat a derivative? Derivatives are kept in the financial statements using fair value through P&L approach. So we keep the derivatives initially at cost and then we take them to fair value at each reporting date with the gain or loss being reported in P&L, right? Then comes the concept of speculation. See, derivatives are only kept for speculation. You never enter into a derivative transaction for taking delivery of something. So if I enter into a transaction of buying petroleum after 2 months, if I'm doing it for the sake of gambling, if I'm doing it for making gains or losses, like speculation, then it is a derivative because you have purchased a future contract. You have fixed the price of petrol at which you will buy petrol. Then it is a derivative. But if you are getting into that transaction and you are going to use that particular item for own use, you are going to take delivery. You're going to take delivery of that particular good. Then we say it is instead of a derivative, rather we say it is an executory contract. So see, I give you a sentence. Company A entered into a future contract to buy petroleum after 2 months at a fixed price. How should you treat it? How should you treat it? This future contract, number one, if it is taking delivery of petroleum for use in business. Number two, if it is not taking delivery or not using petroleum. These are the two situations. See, in the first situation, if you're going to take the delivery of that particular product, that means you're doing it for your business. That's not speculation. So it will rather be an executory contract. So whenever you will enter that arrangement, whenever you'll actually buy petroleum on that particular date, you'll record it on that date only. But if you're not taking the delivery and you have done this for speculation, then today only you will record it as a derivative. It's a future contract for you. Correct? So this is how we basically account for derivatives. Okay. Then there are certain derivatives which we have to see in the pretext of settled net in cash. How do we see whether a derivative is settled net in cash or not? Because if it will be settled net in cash, then only it is a derivative. Otherwise, it is not. So how we are going to see that? See, settled net in cash. How we are going to check that out? For it, we need to see either it will be settled net in cash as per contract. It's written in the contract that this derivative will be settled net in cash due to any particular such thing written. I'll just look at a question for you after this to explain you this settled net in cash concept. So either it is written in the contract or it is a past practice that generally, when you enter into this transaction, you end up getting cash. It's not a product or a good that you get, you end up getting cash. So either it's a past practice or you will take the delivery of that particular item and you will sell it. Even that is meaning that it is settled net in cash. So settled net in cash is another word for speculation. Basically meaning that you're not taking delivery for that particular good or service. You're rather settling it in cash. You are rather selling it. You're rather getting gain or loss in cash. You're doing it for speculation. Right? So let me show you a question which is gas nature. Have a look at it. 6 marks. Gas nature wishes to know whether the contract with a gas should be accounted for under IFRS 9. So gas nature has entered into a 10-year contract with a gas for the purchase of natural gas. Gas nature has made an advance payment to a gas for an amount equal to the total quantity of gas contracted for 10 years. So what you have done is you have entered into a 10-year contract and you've already made the payment, which has been calculated using forecasted price of gas. The advance carries interest of 6% per annum, which is settled by way of supply of extra gas. Now, because you're paying advance, that means you're losing your bank interest. So you will charge the interest from the counterparty. So they are saying if you want to charge us interest, instead of that, we will give you extra gas. So fixed quantities of gas have to be supplied each month. And there is a price, each adjustment mechanism. There's a price adjustment mechanism, okay, in the contract whereby the difference between the forecasted price of gas and the prevailing market price is settled in cash monthly. If a gas does not deliver gas as agreed, gas nature has the right to claim compensation at the current market price of gas. Now they wish to know whether you should account for it under IFRS 9 or not. What do you think? What should I do with gas nature? Is it settled net in cash? Should I be recording this as a derivative, or should I not be recording as a derivative? Is it an executory contract? See, here they have asked for 6 marks. You are correct that this is an executory contract. Why? Because we are entering into this transaction for what? We are entering into this transaction for gas that we want to use in our business. So this is clearly not like speculation. But before that, is this something which is settled net in cash? What do you think? Is this something settled net in cash? Is it something settled net in cash? How are we going to decide it? Okay, see, when we are talking about the concept of setting net in cash, we are saying whether it is a derivative or not. See, when we are trading with something which is a financial instrument and it is, meeting these 3 criteria, then it is a derivative very easily. But if something is a non-financial instrument, for example, here, gas is a non-financial instrument. So for those non-financial instruments, I have to put this test that is this settled net in cash? So either as per contract, it is settled net in cash, or as per past practice, or you take the delivery of the non-financial item and then you sell it, or when the non-financial item is subject to the contract is readily convertible into the cash. When that non-financial item is such that it can be readily convertible into cash. These are the four things that we see. Now, over here, if you read the question properly, they are saying that we have paid cash and we are going to get gas in return, and the interest will also be in way of extra gas. And whatever is the difference between the forecasted market price, okay, and whatever is the current prevailing price, whatever will be the difference, it is settled net in cash. But the point is that we are not going to encash this gas once we receive it. We are going to use it in the business. So that is why, rather than settled net in cash, it is an own use asset. We are not going to sell it. So in contract, it seems like it will be settled net in cash up to some extent only. There is no such past practice that we receive gas and then we sell it. We don't take the delivery and sell it. We rather use it in the business. So this is not a non-financial item. Gas is not something that you can readily convert into cash. It is inventory. Inventory is not a quick asset. It's not a liquid asset. So rather, it's an own use asset. And whenever it is an own use asset, we classify it as executory contract. So this is an executory contract instead of a derivative. That's what we were supposed to mention over here in gas nature company. Right? Okay. Are we clear on this? Yes, I will tell you, guide you on technical articles and current issues, but at least listen to financial instruments first. Very important concepts we are doing. Okay. Then let's discuss hedging. Last concept of IFRS 9. Hedging. And a very important one. Guys, I need high energy. Come on. Are we ready for hedging? Now that is something which is going to blow your mind. And it generally blows mind for all the accountants. And that's why, in audit, we say hedging is an inherently risky area, because hedging is not something which is everyone's cup of tea. So when do a company enters into a hedge? When there is a hedged item that they want to protect against the fair value, or they're wanting to protect the cash flow. So hedged item is there, and then due to that, we enter into a hedging instrument. Okay. So there are two types of hedges. One is cash flow hedge, where you're trying to really protect yourself against the cash flow. For example, if you're protecting against ACCA subscription, you pay it in pounds. So maybe you know that my subscription is due at the year end. So you know that the GBP will increase as compared to your domestic currency, let's suppose Indian rupees. So you are very worried about it. So today only you enter into such a transaction that I have to pay cash at the year end. So let me hedge against the foreign exchange fluctuation. So you will enter into such a transaction which will favor you if the GBP becomes stronger. Because stronger the GBP becomes, more money I'll have to pay in INR. And so now I will buy such a derivative that if GBP becomes stronger, I will make a gain. So even if I make a loss on my cash flow transaction to pay subscription, I will still make a gain on the derivative that I purchased. That is hedging. When you want to come to net, no loss, no gain situation. Right? So there is a cash flow hedge when we are hedging against cash flow fluctuations. And then there's a fair value hedge. Now, how do you accounting? What we want to do in SBR is the accounting treatment. We don't care about how hedging happens. We care about how to account for it. Now, when do you apply hedging rules? When the hedge is formally documented, okay, and the hedge effectiveness criteria is met. That's when you actually do hedging. You apply hedging rules. Now, how do you see whether hedge effectiveness criteria is met or not? What is the hedge effectiveness criteria? Number one, there is an inverse economic relationship between the hedged item and the hedging instrument. So basically, if there will be a gain on one, there will be a loss on another. Then only you can settle the gain with the loss and come to no gain or loss situation, right? So there should be an inverse economic relationship between them. Second thing is that the hedge ratio is apt. So you should be able to, for example, the cash that you have to pay to ACCA is £100 and you purchased a derivative of £10. So that is not going to help you. You are going to buy such a derivative which will give you a cover of up to £100, right? So hedge ratio has to be apt. Thirdly, the hedge effectiveness criteria. Come on. What is the third hedge effectiveness criteria? The hedged item fair value should not be dominated by credit risk. Because when we are talking about changes in the underlying item, so let's suppose ACCA subscription. So ACCA subscriptions risk is based on Forex. So we are betting on GBP and INR Forex exchange rate, basically. Now, whether you will pay the subscription or not, that should not impact the fair value of the future probable transaction that you're going to enter into, right? So that's what we're saying. The credit risk, the fact that we will pay or not should not impact the fair value, because then it will totally destroy the basis of hedging. So if you enter into a hedging transaction today to pay the ACCA subscription, and at the end you don't end up paying the ACCA subscription, then that's not valid. That means the hedge effectiveness criteria was not met. Okay, so all these criteria have to be met before we call it a hedge. Now, what is the accounting treatment for cash flow hedge? For cash flow hedge, you have that sibling example with you, because the hedged item is your elder sibling. Just for the entertainment of the hedged item, hedging instrument was brought into the picture. So just for the entertainment of the elder sibling, the younger sibling was brought into existence. Quite offending, but like, yeah, I'm a younger sibling, so my experience. So basically, your parents were saying that the single child was getting bored. He wanted a sibling to play along, and that's why the younger one was born. Similarly, for the hedged item, the hedging instrument was born. So what we do is we take the hedged item, and instrument both to their fair value at the reporting date. Okay, we take them to their fair value at the reporting date, and the gain or loss, it goes via basis on whether it's the effective portion or ineffective portion. So what is the effective and ineffective portion? Understand this. Why I gave you the sibling example. Now, just again, my childhood sad story. So my brother, he was a very decent child until he was in his like bigger standards. So he was a very innocent child, didn't used to trouble parents a lot. But I was kind of notorious. Okay, that's what my parents say. Now, um, so whenever we were going out and for, let's suppose, shopping, and my brother would not ask for something, and I would be very anxious and I would be like, I want this, I want this. So my mother would say that he's not troubling me much as you are doing. So basically, just converting that sentence into effective and ineffective portion. So you brought the hedging instrument, you brought the younger sibling for the elder one. So now parents are thinking the elder one is not troubling us, but the younger one is troubling us. So this younger one, up to the extra trouble that he or she is giving, is the ineffective portion. Okay? Is the ineffective portion. So what does this mean? If the ineffective portion is if the fair value movement in hedging instrument is greater than the fair value movement in hedged item, then the extra movement is classified as ineffective portion, which goes via statement of profit and loss. And the effective portion that goes via other comprehensive income. Yes. So ineffective portion goes via P&L and effective portion goes via other comprehensive income. Why OCI? Why P&L? Honestly, even ACCA is confused on that. And they also, sarcastically, they also had a, kind of a current issue on this few quarters ago, where they said that this is a problem, how to treat cash flow hedge and fair value hedge, why OCI and why PL. It's a very huge problem. So we need a solution to it. We need a logic to it. So they are also finding a logic. Till date, they don't have a logic. ISB does not have a logic. Why OCI for cash flow hedge and why P&L for fair value hedge? So they don't have the logic. We don't have the logic. So we'll have to cram this. Sad, but true. Okay. Then fair value hedge. For fair value hedge, what do? Again, you take the hedged item to its fair value. You take the hedging instrument to the fair value. And whatever is the gain or loss, you report it into statement of profit and loss. Only one exception is there. What is this exception? Exception is if the hedged item was an equity instrument kept under fair value through OCI, then only the gain or loss will go via OCI. That's it. So this is what we have as rules for cash flow hedge and fair value hedge effectiveness criteria, and the hedging standard. Now, if it comes up, you can consider that like a bad luck, because hedging is a difficult topic. I admit to it. There are questions in Super 20 questions which I have included in hedging. Let me see if you have it here. But you should know the basics, okay? If you will know the basics, you will be easily able to manage at least passing mark. I'm not talking about like full-fledged good score, but at least passing mark you can get if you will be able to manage the basics, okay? So here also wood fleet, in one of your very important Super 20 questions, you had hedging here. So see, what was the hedging transaction happening here? Let's look at it. On 1st November, Woodfleet entered into the advanced stage of negotiations for the purchase of factory buildings situated in a country where krone is the currency. The purchase price of factory building will be paid in krone. The purchase is not expected to complete until March 2026. So Woodfleet entered into a forward contract to manage foreign currency risk arising on future probable transaction. So future probable transaction is a hedged item which is not yet recorded in the balance sheet or P&L, right? It is a future transaction. So the forward contract is settled net in cash. So that means it is a derivative, right? The fair value of the forward contract at this date was nil. So the arrangement was designated as a cash flow hedge and all the effectiveness criteria was met. So by 31st December, a loss of 5 million had arisen on highly probable future cash flow transaction. So there is a loss on hedged item of 5 million. And the fair value of the forward contract is 5.4. So from 0, it went to 5.4. So there is a gain of 5.4 on the instrument. Okay. So there is a gain on hedging instrument of 5.4. And on the hedged item, there is a loss of 5. And this is cash flow hedge. So what should be the accounting treatment? What should be the accounting treatment? Basically, in the question, they're saying there is a loss on hedged item of 5 million. and there is a gain on instrument of 5.4, and this is a cash flow hedge. So we will say 0.4 will go to P&L as this is ineffective portion, and then we have the remaining 5 million that will go to other comprehensive income because this is a cash flow hedge, right? Now, what have they done? In the draft consolidated statement of financial position, the forward contract has been remeasured to its fair value. The gain of 5.4 is recognized in OCI, in the draft P&L and OCI. The gain of 5.4 million has been recognized in other investment income of P&L. So what do you think? What wrong thing they have done? They have taken it to P&L. Other investment income is there in P&L only as per IFRS 18. So they have taken it to P&L. So that's wrong. So we'll say 0.4 should have gone to P&L, 5 should have gone to OCI. That would have been the correct treatment. Okay. So let's move on further. We are done with IFRS 9 now that I wanted to share with you a proper note. So I prepared it on the Word file. Okay. So you have a Word file on IFRS 9 now, which you can revise before your exam. Now we'll take a break of another 5 minutes and then we are going to continue with group accounts. So group accounts is going to be a little quick. So I want you to be very much here in the session. So let's meet after 5 minutes with group accounts. Okay. Yes, we will do employee benefits. We will do share-based payment and everything. Don't worry. That is going to be very quick. Those are very small standards. I'm going to revise the syllabus with you fully. So let's meet after 5 minutes for group accounts. Yes, guys, I hope we are back from the break and we have had our due time to enjoy. It was more than 5 minutes, so I hope you are now excited and ready for the next concepts. Yes? Am I audible? Am I audible and visible to you? May we start with group accounts? Okay, so we are having discussions. What are you having for dinner? Even I'm not sure what to have for dinner. Okay. Give me suggestions, okay? Vegetarian options. Let's continue. Group accounts. Now, guys, group accounts is something that is surely going to come in question number 1. We are damn sure about it, right? There's no question on that. So this is something we should be very well prepared, and this is the most important area of your syllabus. And to add to our trouble in this area, we have this new animal in the town, pre-populated spreadsheet. Now, many people, they are so afraid, okay? Uh, they are so afraid about this that they end up leaving pre-populated spreadsheet. So I am going to today, when I shared, I don't know if you have got that PDF or not. My students, you already had that PDF, but still I saw you commenting on the reel. I don't know why. But the pre-populated spreadsheet PDF that I prepared, the journal entries, I'm going to explain that PDF to you in the class today, so that you know exactly how the journal entries are being made in pre-populated spreadsheet. Now, before I move into the question, you look at Woodfleet Company. Woodfleet Company has a draft P&L and OCI. It's a past paper, the most recent past paper, September-December 2025, which is available with us. Here we had a pre-populated spreadsheet of P&L. And here, we did not even have a subsidiary. We were talking about an associate. And that associate was basically what we sold, okay? What we have sold during the year, and that too, it was a foreign associate. Okay, so this was kind of a very strange question related to P&L, group P&L. So pre-populated spreadsheet is there. For that, we need to first understand basics of group accounts. So we should know the definition of control. When do you have control? When do you develop a relationship of parent and subsidiary? When do you have that relationship? See, parent is basically someone who controls the subsidiary. And control comes from IFRS 10. You have this definition that control comes when there is power over the investee. How do you have power over the investee? You have the right over variable returns. Okay, so you have the right over variable returns. So basically, you have the right over the profit and losses of that particular company, and you have the ability to effect those returns. You have the ability to effect those returns. So if these conditions exist, that's when we say that we have control. Now, control does not necessarily means that more than 50% shareholding. So generally we say if we have more than 50% shareholding, we have control. But control comes from this particular mindset where we have power. Power comes from voting rights. How can you impact the profit or loss of a company if you will have voting rights? Voting rights are generally associated with shareholding. So basically, you should have majority voting rights. You should be able to appoint majority board of directors. Okay. So somehow this is what we consider when we talk about control. Okay. So it's not just shareholding. So there are situations where we might have less than 50%, but still control exists. That's why in SBR, this is a very famous question. to identify who is the acquirer. Who is the acquirer? Because sometimes we don't know who has obtained the control, because it's not just about 50% of the shareholding. Okay, so we say that the person who controls the management, the person who can appoint majority of the board of directors, the entity which has, which is generally the bigger entity, the entity which is generally the bigger entity, the entity which you can say has, let's suppose, issued shares, has paid cash, the entity that has basically owns majority of board of directors, the entity which controls the combined management. So that is the entity which is generally considered as the parent and the acquirer, correct? So this is the relevance of definition of control. Now, what is the ladder of control? How does it look like? If you have 0% in a company, you are unrelated. If you have something between 0% to 20% shareholding, we call it as a financial asset. Financial asset means IFRS 9 equity instrument. If you have between 20 to 50%, we call it as a situation of associate. Okay, we call it as a situation of associate, where we do equity accounting as per IS 28. Then if you have more than 50%, then generally it is parent and subsidiary relationship, because then you exercise control. So in associate, you don't have control, rather you have significant influence. So significant influence is basically when you can have a power to participate rather than a power to control. Okay. So this is what basic theory of control and who is the acquirer, which is generally tested in SBR, looks like. So generally you will see a requirement, who is the acquirer, whether control exists or not, whether it's an associate or whether it's a subsidiary. For example, let me show you some questions where for maybe around, a few marks we are having these discussions. So let me show you the Hummings company, I believe. Okay, this is not this one. See, Colombia. How does the question start? 8 marks, whether Colombia should be considered as the acquirer in the combination with Peru or not. So what I just discussed in theory with you, for 8 marks, we were applying it in this question. So we could have got our easy marks by just stating the theory. So first stating the theory would have given me around 4 marks, and then plus 4 marks, I would have done the application, right? That's how the question standard works. You have to state the standard and then apply. So this is how this question was tested. Okay. Then comes the question, once we know that there is a control existing, how to prepare group statement of financial position. For that, we have 5 working notes. So in working note number 1, we talk about the group structure. So we basically talk about who's the parent, who's the subsidiary, who's the associate, who is the acquirer. We identify all of that. Second is we talk about fair value of net assets of the subsidiary. Fair value of net assets of the subsidiary. So how do you know about fair value of net assets of subsidiary? What are the net assets? Share capital, share premium, other components of equity, retained earnings. What were the fair value of net assets at acquisition date versus what was the fair value at reporting date? And the difference between the two is post-acquisition movement. So when we acquire a subsidiary, we as a parent have a share in post-acquisition movement. Okay. So we look at the values at acquisition date and at reporting date. Okay. Now, the company might have recorded something at the carrying amount, not at fair value. So there are fair value adjustments which happen, which can happen to, land and building, which can happen to property, plant and equipment, which also leads to additional depreciation. Now that additional depreciation, guys, is just adjusted in the reporting date column because additional depreciation is an year-end expense that does not impact acquisition date column. Then the working note number 3. Working note number 3. You have goodwill. Now there are two types of goodwill. Full goodwill, proportionate goodwill, right? So full goodwill means, how do you calculate full goodwill? You take the fair value of consideration paid. When you acquire a company, how much did you pay to acquire it? It can be in terms of cash, it can be in terms of share for share exchange, it can be in terms of deferred consideration, which you calculate at present value. It can be in terms of contingent consideration, which is probability weight, right? So fair value of consideration, I take that. Then I add NCI to it. If I am calculating full goodwill, I will take NCI at fair value. From this, I am going to deduct the working note number 2, that is fair value of net assets of subsidiary at acquisition date. So basically what I'm calculating is how much I paid to the subsidiary to acquire it. I and NCI both paid to the subsidiary to acquire it versus what it was worth. That gives me full goodwill on acquisition. But when I'm calculating proportionate goodwill, the formula kind of changes. So now you take fair value of consideration paid by the parent. Okay, fair value of consideration paid. Now you take NCI, but it is not at fair value. Rather, you take it as a percentage of working note number 2. So you don't look at how much NCI is actually paid to acquire the subsidiary, but you look at how much it should have paid. So basically, you check the net worth of the subsidiary from working note number 2, and you calculate NCI's percentage in it. From this, you deduct the fair value of, again, working note number 2, fair value of net assets of subsidiary, and you get proportionate goodwill, which is partial goodwill. Now, this goodwill, if it is impaired in future, the impairment of goodwill just belongs to the parent. It just belongs to the parent. It does not belong to the subsidiary. Secondly, impairment, and also if in future for foreign exchange, if I'm calculating, if I'm retranslating this particular goodwill, whatever foreign exchange gain or loss will arise on it, that will only belong to the parent, not to NCI, because NCI has no share in this proportionate goodwill. Now we will refer back to the concept of CGU that I talked about, IS 36. When I was talking about IS 36, I told you that for a CGU, goodwill is a corporate asset, right? So generally we do consider goodwill in a CGU. Now, if a goodwill is recorded, in a CGU at proportionate basis, so you have recorded a partial goodwill, but the recoverable amount that comes from the market, that has recorded full goodwill. So you cannot compare the full goodwill with proportionate goodwill. So recoverable amount of the CGU comes from the market, which indulges full goodwill, but the carrying amount that you've calculated, that is coming from proportionate goodwill, partial goodwill. So to make it comparable in my working note, what I do is I take this proportionate goodwill to total notional goodwill. I gross it up. So basically, I apply unitary method, right? I apply unitary method. So what do I do? What do I do? I have basically, for example, NCI percentage is 20% and the goodwill on acquisition proportionate goodwill was 100 million. So I will say if 80% of goodwill is 100, 1% will be 100 divided by 80%, and 100% will be 100 divided by 80 into 100. So this is how I come to know about total notional goodwill. Now I will use this total notional goodwill for the calculation of impairment of a CGU, and then I will allocate the impairment to the particular goodwill that was already recorded in the balance sheet. So now you should know the concept of total notional goodwill. It's a revision, okay? So I hope you remember the concept of total notional goodwill. Okay, so that's working note number 3. Then working note number 4. NCI. So what I do is I take NCI at acquisition, whatever was recorded at acquisition, whether it was at fair value or whether it was at proportionate basis, I take that accordingly. In that, I add NCI's share in post acquisition movement of net assets of the subsidiary. Now that is going to come from working note number 2. Then if it was a full goodwill, then NCI share of goodwill impairment. Then if there was a foreign subsidiary and the goodwill was impaired, then maybe NCI share of retranslation reserve. Retranslation gain or loss. All of that comes here in working note number 4. Then you get NCI at reporting date. Then working note number 5. Group retained earnings. How do we start with group retained earnings? We take the parents' retained earnings from the question first, because we have to consolidate it at 100%. Then we add parents' share in post-acquisition movement. So we look at the working note number 2 and we take parent share in post-acquisition movement of the retained earnings of the net assets of the subsidiary. Then we show parent share in goodwill impairment. Let's suppose there is a goodwill impairment. Now, retranslation reserve does not come here because that goes via other comprehensive income. So we are not going to talk about that here. Then if there is any intragroup transaction which is impacting the parent share, all of that is recorded in working note number 5. Let's suppose there was a deferred consideration which parent was paying. So on that, you must unwind the interest. So unwinding of interest will also happen here. All of the things that impact the retained earnings, which can't be predicted, it varies from question to question, that comes here in working note number 5, right? This is how the things work. Now, if there is an intragroup transaction. So if parent is the seller to the subsidiary, so what is happening? They have recorded the goods at, it's like an intragroup transaction. I need to eliminate the intragroup transaction and balances. So parent has sold goods. So parent has recorded extra profit. So I need to figure out how many goods are still there in the inventory of the subsidiary. So how many are still there in the warehouse? On that, I have to calculate PURP. So whether the profit was markup or margin, that's how you decide it, whether it was markup or margin. Markup is always at cost and margin is always at selling price. Okay, always remember that. So when parent is the seller, your journal entry is, what will the parent pass as a journal entry in group accounts? It will say, my group retained earnings will decrease. So debit group retained earnings and group inventory credit by the amount of PURP. And if subsidiary is the seller, then the journal entry will be, because subsidiary has recorded extra profit now since it is a seller, and subsidiary's profit is shared between parent and NCI. So GRE will be debited and NCI will also be debited by their percentage. Parent's percentage here, NCI's percentage here. And group inventory credit by the amount of what? PURP. And what do you do for if you are making group statement of profit and loss? Like in Woodfleet, we had an intra-group transaction and we were talking about group P&L. How do you treat it there? You remove the intra-group sale, whatever was the total intra-group sale, remove from revenue. Okay. Remove it from cost of sales. Add PURP to cost of sales. Because basically you have to remove the unrealized profit. So by adding it to cost of sales, you are reducing that profit. That's what we basically do in intragroup transaction in case of P&L. Right? Now, these intragroup transactions can also be between parent and associate. So you should understand that how it happens. But I've given you the logic how to develop the journal entry or how to record it in the P&L. Okay. Now comes how to treat an associate as per IS 28. So associate is recorded in P&L as well as balance sheet. So in the balance sheet, how do you record it? You say cost of investment in associate. Okay, you take that. In that, you add share of profit in associate. So how much share of profit do you have in associate? That is the post-acquisition movement of associates' profits. Woodfleet company is a very good example to practice associate and, foreign associate that too. So it's amazing question. So the one that I was showing, September, December 2025. So cost of investment in associate, share of profit in associate is added into it. And then from this, you deduct if you have already received dividends from associate. You deduct that. Okay. And if there was any impairment of this investment, you deduct that as well. And you get associate at reporting date. Out of this share of profit in associate goes to statement of profit and loss in what activity? Investing activity. Because associate is your investment. Correct? It goes into investing activity as per IFRS 18. Now, guys, let's look at the journal entries sheet that I have prepared for you. Let's look at the journal entries. Okay. Basic journal entries, first of all. Because if you're doing pre-populated, you should know how they are posted in the balance sheet. For deferred consideration, let's suppose in the question they are saying that there was a deferred consideration to be paid by the parent. So if we are making a balance sheet, I'm assuming we are making a balance sheet. So deferred consideration, if it was, let's suppose in the question they said, we forgot to record a deferred consideration. How do you record it now? First of all, you will take it to its present value. Then what you are going to do? You are going to increase your goodwill because it will impact working note number 3. So deferred consideration does it impact working note number 3? Yes, it increases the goodwill. So goodwill debit and a corresponding provision is recorded because parent forgot to record deferred consideration. So goodwill debit, provision credit. Now, because it is calculated at present value, there will be a future unwinding of interest also. Now, because this particular deferred consideration only belongs to the parent, because parent is paying the consideration, that's why only GRE will be impacted. So when you unwind the interest, your entry will be GRE debit and provision credit. So finance cost debit and my provision credit, right? Now, during a pre-populated spreadsheet, let's suppose there was a fair value adjustment, which has led to increase in net assets of subsidiary at acquisition. So what you will do? You are going to debit that particular asset because the value has increased and that will increase the goodwill. Why? Because subsidiary is now worth more. So what you pay versus what it deserves, difference reduces. So basically, when you're making working note number 3, what is your formula? Fair value of consideration paid plus NCI. Whatever I get from that, I deduct fair value of net assets of subsidiary. Now, if this value, fair value of net assets of subsidiary will increase, so definitely the goodwill will decrease, right? So that's why net asset debit, goodwill credit. And the reverse of it, what if there is a decrease in net assets? Goodwill will increase, net asset, whatever is that asset, if there was a fair value downward, you will credit it. If there is an additional depreciation, what will happen? Let's suppose at acquisition date, the subsidiary had a plant and machinery whose fair value upliftment was of $10,000. And the life of plant and machinery was 10 years. So its additional depreciation would be how much? $1,000, 10,000 divided by 10. Now, this is a subsidiary's assets which was taken to its fair value, and this is subsidiary's additional depreciation. In this, parent and NCI both have a share. So how will you account for this additional depreciation? This is going to decrease the parent share of the additional depreciation, GRE debit. This is going to impact NCI also. So NCI debit, and the asset is going to decrease because of the fact that it is a depreciation. So GRE debit, NCI debit, by parent share here, by NCI share here, and asset credit. Right? Now, this is the intra-group transaction that I've already covered with you. If parent is the seller and if subsidiary is the seller. Okay. If share of profit from associate is to be recorded. Let's suppose in the question they have forgotten to record the share of profit due to any XYZ reasons. So how will you record it? In the balance sheet, you will say investment in associate debit, because share of profit, it increases your cost of investment in associate. So investment in associate debit, and it impacts my profitability. In P&L, it will go into investing activity. Okay. And in my balance sheet, it is going to increase my group retained earnings. Now, if you receive dividends from associate, that decreases your cost of investment in associate. So bank debit and investment in associate credit, because my cost of investment is going to decrease. Now, if associate is the seller, if an intra-group transaction is happening where associate is selling some goods to the parent, so associate has recorded the profit and I have a share of profit in associate. This is an intra-group transaction. So share of profit in associate will decrease because this is an overstated associate's profit, right? Because this is an intra-group transaction, associate should not have recorded this profit. So share of profit in associate is going to decrease, and inventory credit. Okay. Then if parent is the seller, GRE, parent has recorded the profit now. So GRE debit and investment in associate credit by the amount of PURP. Okay. Then comes, let's suppose in the case study of question number 1, they said we have forgotten to account for goodwill impairment. Now, if it was a full goodwill, I have to see that. My NCI will reduce by its amount, GRE will reduce by that amount, and goodwill will decrease. Okay. Now, if it was a partial goodwill, then only GRE will decrease and goodwill will decrease. And also don't forget to calculate total notional goodwill. Okay. Because it was partial goodwill. Now let's discuss another concept. This was basic group accounts that I've discussed with you, which is, mind you, very important. More than anything else, this is more important. Then comes change in group structure. Change in group structure. Okay. So when we are moving up the ladder, it's not necessary from 0% shareholding, I'll directly move to 100%. I might have to move in steps. So I move from, let's suppose I was having 20%. So I move from 20 to 60%. So that is termed as step acquisition, where I'm moving from no control to control. Correct? I'm moving from no control to control. Similarly, there can be control to control transactions also. Maybe I already have 60%, but now I move to 100%. Step acquisition, control to control. Similarly, there can be step disposal as well. You can move down the ladder in bits and pieces also. So maybe you are moving from, there can be two scenarios. You're moving from control to no control, or you're moving from control to control. Step disposal, right? This is how we actually do it. Now let's look at step acquisition. Step acquisition. First scenario, when I'm moving from no control to control. So let's suppose I was having an associate and now I am moving to a subsidiary. You will see this a lot in question number 1. Okay, very easy part. Maybe you're moving from associate to a subsidiary. So in this case, what you say is you say bye-bye to IS 28 and you say hello to IFRS 3 and 10. So you say bye-bye to IFRS, you say bye-bye to IS 28 and hello to IFRS 3 and 10. Now guys, when I say buy to something, I have to take it to fair value first. So I will take my investment in associate to fair value. And then I am going to de-recognize it and record the gain or loss in statement of profit and loss. That's how you say buy to IS 28. You first take it to its fair value. You take the gain or loss in P&L and then you de-recognize that associate. And corresponding to this, because you're not selling the associate, you're not going to get money for selling it. Rather, you're going to get control. So your contra entry will be goodwill. So when you get control, you have to start consolidation and you have to calculate goodwill. So you have to start consolidation and you have to calculate goodwill. How do you calculate goodwill? You all know, using the working note number 3, based upon full or proportionate goodwill, that how we actually do the consolidation process. So when you'll calculate the goodwill, you will take this time fair value of consideration paid by the parent, plus you will take fair value of investment in associate that you have de-recognized because its contra entry is associate, is goodwill, plus NCI. And now whatever you get from that, you will deduct fair value of net assets of subsidiary. Correct? This is what you do when when we are moving from no control to control. So let's see what I've given to you in the notes. When you're moving from no control to control, first take the previous associate to fair value, investment in associate debit, okay? And this is like you're taking it to the fair value, and GRE credit for the fair value gain. Now calculate goodwill and de-recognize the associate at fair value. So goodwill debit and investment in associate credit. These are the journal entries that you post when you are moving from no control to control. Okay. Second scenario, when I am moving from control to control. So I already have 60%. Maybe I purchased 20% more and now I have 80% shareholding. Maybe this is the situation. Okay. So what I'll do is I will look at NCI. What is happening to NCI? Here the NCI is basically reducing. I will still have control. So there is no point of calculating goodwill again. So goodwill is already recorded. Consolidation is already happening, but your percentage is changing. So its impact is on NCI. So you will calculate the reduction in NCI using the unitary method. So you will see how much NCI do you have right now? 40%. So if 40% of NCI is X amount, 1% will be X divided by 40%. Now my NCI is just left at 20%. So 20% is X divided by 40 into 20%. So using unitary method, you finally get what is your reduction in NCI. And how do you record it? What is the journal entry to record reduction in NCI? Because when you purchase, step acquisition means money is going out. NCI reduces. So NCI debit, bank credit. Now, it's not necessary by the amount with which NCI is reducing, you have paid the same amount to, acquire more shares. So there's a possibility you have paid more or less. So that balancing figure goes to other components of equity. That's a balancing figure. Then for step disposal, you further have few steps. Either you are moving from scenario number 1, you're moving from control to control. So here same thing is happening, but instead of decrease in NCI, there is an increase in NCI. So the journal entry is bank debit, money comes in because it is a disposal, NCI credit, and the balancing figure goes to other components of equity, right? But when we are moving from control to no control, that's a very important phenomenon. Here we calculate profit or loss on disposal of subsidiary. So basically you lose the control on the subsidiary. So you have to stop consolidating that company. You have to calculate how much profit or loss you have made out of that company. So we apply the happy sat formula. When you dispose a subsidiary, you get proceeds, right? So proceeds are something which make you happy. So you say, yes, I've received the proceeds. So add it. Now let's suppose you have sold, you already had 60% shares in a company. You sold 40%. So you're left with 20% still. So there is still some retained interest. So what is the fair value of retained interest? You also take that into account because you're happy about it. You still have some share in that company. You're also happy to get rid of NCI at the disposal date. You're also happy to lose NCI at the disposal date because NCI is a headache, okay? It has a credit balance. Then, what you are sad about? You're sad about losing the goodwill of this company. So goodwill at disposal date. So using the case study, you will have to calculate all these figures. So you're sad to lose that, so minus, okay? Then you're also losing fair value of net assets of subsidiary at disposal date. So you also sad to, not have that particular subsidiary's net assets. So this gives you a total net gain or loss by selling that subsidiary, which goes to group P&L, right? So what do you do in case of step disposal? See, in case of step disposal, when we are moving from control to no control, our entry is bank debit because money comes in. NCI at disposal date is removed, so debit. Goodwill goes out, so credit. Fair value of net assets of subsidiary at disposal date, credit. That means we are de-recognizing the net assets. This gives us profit or loss on disposal. Okay. But we also record here, one thing here, we also record fair value of retained interest. So here I have assumed that we have sold 100% of the subsidiary, but sometimes we might have some retained interest as well. Okay. So this is how you record it in the pre-populated spreadsheet. That was for your, what do we say? Change in group structure. Next important concept is group foreign exchange. So for group foreign exchange, there are certain rules that you should be aware about. Let's understand those rules. It will take us 2 minutes. IS 21 for individual accounts. IS 21 for individual accounts says that you have to see if you enter into a foreign transaction, if related to that transaction, there is something still there in the balance sheet or not. Now, if that thing is monetary or non-monetary, that's what you have to check. What is monetary? Something that is readily convertible into cash. If that thing is monetary, then you have to take it to its exchange rate. Like you have to reapply the exchange rate, that is the closing rate. And this is going to give rise to gain or loss, which is termed as exchange gain or loss, which goes to statement of profit and loss, right? If it is a non-monetary, you keep it at historic rate. So if you entered into a foreign transaction, whatever was the rate on the date of transaction, you keep on recording it that. So that is the rule of IS 21 for individual financial statements. What is the rule for foreign subsidiaries? What is the rule for foreign subsidiaries? Let's understand. First, I should know the concept of functional currency. Functional currency is the currency of primary economic environment. So you can get direct questions like Humming Company, where the first question is where they ask you, determine the functional currency of XYZ company. So how do you know about the how do you know about the functional currency? You look at primary factors and you look at secondary factors. What are the primary factors? Primary factors are the currency in which the company quotes its selling price. How do you sell your goods and services? In which currency are you quoting it? Then the currency in which you incur your direct cost. Then the currency in which your competitors operate. Generally, these are primary factors using which you decide your functional currency. Then, secondary factors say the currency in which you incur your indirect cost. The currency in which you incur or you take a loan. Generally, that is your secondary factor to decide functional currency, right? But for a subsidiary, guys, before I apply primary or secondary factors, I have to see if subsidiary is autonomous or not. If the subsidiary is autonomous or not. That's what I have to see. How can I check that? How can I check that? If the subsidiary is autonomous or not? I will look at whether it has its own finances or not. I will look at it in the case study if it has its own finances or not, if it is depending on the parent for funds or not, all of that. Now, if the subsidiary is autonomous, then it will apply its primary and secondary factors to determine that what is the functional currency. Then it will determine its primary and secondary factors to determine the functional currency. But if it is not autonomous, that means it's dependent, then parent's functional currency will be equal to subsidiary's functional currency, no debate. But what happens if parent's functional currency is not same as subsidiary's functional currency? What are the rules? I will have to do retranslation. Subsidiary will have a different functional currency, but for the sake of consolidation, there will be retranslation. All assets and liabilities will be retranslated using closing rate. All income and expenses will be retranslated using average rate. And this is going to give us a difference that is termed as retranslation reserve. And this retranslation reserve goes via other comprehensive income. Yes, so you have seen questions like, you can try questions like Hummings, where we discuss about foreign currency. Also, this question that I was showing you, Wood Fleet. This is also having foreign subsidiary, a foreign associate, and we are applying the same rules. See, they have given you the exchange rates here, and we are applying the same rules where basically we are given the opening assets and the income or loss of the associate, and then the closing. And we are applying the exchange rates, and that is giving us a retranslation reserve. So I will post a video on Wood Fleet. I've already shared done this question with my students in Super 20 classes. So I'll post that class on YouTube as well soon, maybe tomorrow. So you must try Wood Fleet Company question. Okay, that's very important. That is also related to foreign currency as well as associate and P&L. So these are the theoretical rules of retranslation. right? And this retranslation reserve, it is reclassified. It is reclassified to statement of profit and loss when you sell the foreign subsidiary. So in Woodfleet, the same rules of foreign subsidiary we have applied to foreign associate. That's why this question is very, very important. Okay. Now that's group foreign exchange. So I have given you the journal entries over here. How do you record retranslation reserve of net assets? So net assets debit, retranslation reserve credit, NCI credit. So if there is a loss on net assets, that will reduce net assets. Parent share will go to retranslation reserve and NCI share will impact working note number 4. Retranslation of goodwill. If it is a partial goodwill, goodwill will decrease and retranslation reserve will be created. Why? Because this is just belonging to the parent. If it is full goodwill, then we have a difference between parent and NCI. So goodwill will reduce because of the retranslation loss in this case, and retranslation reserve is created and NCI is credited. This is basically what I'm trying to say is that in full goodwill, the retranslation reserve is shared between parent and NCI. And here in partial goodwill, it is just belonging to the parent. So these are the journal entries that you could have done from the PDF that I have shared with you, right? That's it. So this is how we end group accounts. I know you also have a topic of group statement of cash flow, but that group statement of cash flow does not have a theory. It's more of application. So there is no theory to statement of cash flow. You all know how to prepare statement of cash flow. The format is given to you in the paper. You have to make the adjustments, special adjustments. You will have to make working notes where you will calculate, for example, how much property was actually purchased during the year. So you will make a T-shaped account of PPE to find what was the actual purchase or sale, cash purchase or sale. You might have to make a working note of taxation to figure out how much was the real tax paid during the year. So opening tax liability plus during the year, what was the increase in tax liability, closing. So difference is like what the tax was actually paid, right? So you have to make sure in statement of cash flow, what are the concepts that when you acquire a subsidiary, you pay cash, right? So that is a cash outflow which goes into investing activity because this subsidiary is basically your investment. So it's an investing activity thing. But you record this outflow at net amount because not just that your cash is going out, but subsidiary is also bringing its own cash now. So you can't just say that I've just paid cash. You've also received cash because subsidiary has brought its own cash also. So what you paid versus what you got, record it at net amount, right? Then similarly, when you dispose a subsidiary, make sure you record it at net amount. How much you received versus how much has gone out along with the subsidiary. That's how you calculate it at net amount. Now, when you're talking about cash from operating activities, I am assuming here, I'm not teaching this from scratch. I'm assuming you know how do you calculate cash from operating activity. So you also have a section where you talk about working capital movement, right? Working capital movement. Now, in this working capital movement, if the current assets increase or current liabilities increase, current assets increase, that means money has gone out, outflow. Current liabilities increase, that means money has come in, inflow. So when you're calculating the capital movement, and if during the year there was an acquisition of subsidiary or a disposal of subsidiary, make sure you take into that fact into account while calculating the actual cash movement. So for example, there is an opening, there's an opening inventory. There's an opening inventory. Okay. In that, during the year, subsidiary was purchased. So you compare the opening inventory with the closing inventory. So generally we say closing stock versus opening stock is the movement, which is the cash movement. But during the year, there was a subsidiary purchased. So the closing balance has the results of it. Okay, the closing balance has the results of it, but opening balance does not have the subsidiaries results. So how are they comparable? So what I'll do is I will adjust the opening balance. So I will say opening will be opening plus subsidiaries results, adjusted balance. Now I'll compare it with closing. So closing minus adjusted balance, what comes out is the actual movement, which is your cash outflow. So this is how you have to make sure that cash flow you are taking into account if there was any subsidiary acquired or disposed during the year. This comes with application only. There's no theory to it. There is no pretext to it. It comes with application, with questions, right? So in classes, we have done a lot of questions on cash flow as well. So that from my side ends the topic of group accounts. And from the group accounts topic, I highly recommend that you try these questions. Wood fleet. For my students, you have done this in Super 20. For self-study students, I will be posting it on YouTube tomorrow. Okay. So it's a very important question. Then second thing that I recommend you is Humming's company. That's related to foreign exchange. Third thing, I will recommend you JoCat. These are the three questions that you must try if you feel weak in pre-populated or group accounts. Okay. Now, let's move on to little small standards, which you guys think are very difficult, but in fact are not. I know you guys are tired, but just a sigh of relief, have a sip of water, and then we continue with IFRS 2. It will take me 15 more minutes. IFRS 2, IS 19, and IS 41. Okay. So just a break of 2 minutes. Until then, I'm making it on the board. Okay. Let's continue. So IFRS 2, guys, share-based payment. There are two types of share-based payment. One is equity settled and next is cash settled. So in equity settled, your journal entry is expense debit, equity credit. Then cash settled, it is expense debit, liability credit. So basically you're paying your employees on the basis of shares. So here you give them shares or share options. Here you give them share appreciation rights. So you'll pay them cash on the basis of share price increase or decrease. How do you record the expense and equity over here? How do you calculate it? You take fair value of, or you first take, the formula here is number of share options granted into number of employees who will meet the vesting conditions into fair value of share option at grant date into proportion. So let's suppose the vesting period is 3 years. This is the first year out of the 3 years. That's how you calculate your expense and equity. I talked about vesting condition here. There are two types of vesting condition, market and non-market. So the market conditions are already discounted in the fair value of the share option at grant date. So I do not account for them. For non-market conditions, I do consider on the basis of non-market conditions, how many employees will be able to actually vest and get the share options. So number of employees will be increasing or decreasing basis of non-market condition, right? So this is how you calculate your equity related share-based payment. Then for cash settled share-based payment, what is your formula? You take number of employees, okay? You take number of employees, you multiply it with number of SARs that you have granted. This time you take fair value at each reporting date. You don't take at grant date, the date you gave the share option. You take it at each reporting date. And then you further multiply it with the proportion based on whatever proportion it is, 2 by 3, 1 by 3, 3 by 3. That's how you calculate cash settled share-based payment. So the only difference between the two is that here I take fair value at grant date, here I take fair value at each reporting date. Okay. Now when I am settling my liability, just one point to remember, whenever you're settling your liability related to share appreciation rights, always settle it at intrinsic value. So that's always given to you in the question, intrinsic value of the share appreciation right. So you will just settle the liability at intrinsic value. Okay. Now there is also a deferred tax implication. Deferred tax implication of IFRS 2. See, IS 12 deferred tax say with regards to IFRS 2, it says that when you say expense debit, expense reduces your profit. So basically you save tax. It's a tax benefit, right? It's an allowed expense. So deferred tax say that we will give you the tax allowance for share-based payment expense only when the share option is exercised. That's what IS 12 says. So we will give you the tax benefit only when it is exercised. So today's tax base is 0. You have a carrying amount. You have an expense basically. Okay. You have an expense. Today you incur that expense, but you will get its benefit tomorrow. So can I say it is a deferred tax asset? Can I say it is a deferred tax asset? Because I have incurred an expense today, but I'll get its benefit tomorrow. So I'm going to carry it forward, right? This is going to give rise to a deferred tax asset. So let's just look at a question. Okay. Yeah. See, splash company. So this is what they're saying, that you are supposed to create a deferred tax asset here. And the tax base is expected future tax relief that has accrued by the reporting date based on intrinsic value. And also the tax authorities say that we will give you the tax benefit on the basis of intrinsic value. Okay. So where the amount of estimated future tax deduction exceeds the accumulated remuneration expense, the tax deduction partly to the remuneration expense and partly to equity. So basically what they're trying to say, where the amount of estimated future tax deduction, what we are going to gain in future, if that exceeds whatever we have recorded till date, then that extra amount, okay, it relates to remuneration expense and partly to equity. So that extra amount will go to equity. How? Let me show you in this question. Few more minutes of attentiveness and we are done. T-value 5. So deferred tax is also getting covered here. An entity Splash established a share option scheme for its 4 directors. This scheme commenced on 1st July 2018. Each director will be entitled to 25,000 share options on conditions that directors remain with Splash for 4 years. So that is basically your vesting condition, that the director should stay for 4 years. Information regarding the option is fair value of the option at grant date, exercise price at 5. The fair value of shares was $17 per share. Okay. Tax deduction is only given for the share options when the options are exercised. The allowable deduction will be based on intrinsic value, assuming a tax rate of 30%. So basically, we are trying to say that there is a deferred tax implication here because there's an equity settled share-based payment. So how much expense have we recorded so far? Look at it. There were 4 directors. Each director was given 25,000 shares. And what was the fair value of share option at grant date? This is at grant date, 10. So till date you have recorded out of 4 years, only first year has gone by. So how much have you recorded? 2,50,000. For tax purpose, tax relief is allowed on intrinsic value. What is the intrinsic value? It's not directly given in the question. So how do you calculate the intrinsic value? You calculate the intrinsic value as market value of shares minus the exercise price of the option. What is the market value of shares from the question? 17. What is the exercise price? 5. So I get 12 as intrinsic value. Now I'm going to get my future tax benefit on the basis of $12. So for 4 directors, for 25,000 share options, I will get $12 of benefit. And this is the first year out of the 4 years. So my deferred tax asset becomes how much? 30% of this amount, because you're going to save tax on certain amount, right? The amount is 3 lakh, but you're going to save 30% on it. That is 90,000. Now they're saying this is 300,000. Compare it to what you have recorded so far. So far you have recorded 250,000. So 50,000 is extra. Now that extra goes via equity. So 50,000 is the total base value that is extra. What is 30% of 50,000? 15,000. So out of 90,000, 50,000 into 30%, 15 goes via equity and the remaining goes via P&L. So you record a deferred tax asset, DTA debit, 90,000 for the amount that you calculated above. Now part of it, because 300,000 exceeds 250,000 by 50,000. So what is 30% of 50,000? 15. That goes to equity and the remaining goes to P&L. So this is the very important part of deferred taxation. If you have not understood it, rewatch it, redo it. This is the share option scheme where we relate IFRS 2 with IS 12. Okay, so that's it about IFRS 2. Let's come to IS 19, employee benefits. Employee benefits. See, this is like a pension scheme. I'm going to talk about defined benefit pension scheme. What you have to remember out of this is the formula. To begin with, you either have a net deficit situation or a surplus, where we are talking about pension obligation versus planned asset. Let's suppose there's a deficit. So whenever there is a contribution during the year, there will always be a contribution into planned asset. Yes. So that contribution will be deducted from deficit, because contribution increases the asset and furthermore decreases the deficit. If there is net interest component, that will be added here. Okay. Then there can be, you can say, service cost. Service cost can be current or past service cost. That is also an addition into the deficit, because service cost basically increases the pension liability. Then you also have benefits paid out. They have no impact on it. Then you have closing deficit from the actuary. Whatever it comes versus this amount that you are getting gives you a remeasurement component. And this remeasurement component goes via other comprehensive income, and it is never reclassified to profit and loss. So this is what IS 19 basically looks like. And then there's a concept of asset ceiling as well, where when we practice prudence and we say that our surplus is sealed at this amount, we can't take it more than this. So in that case, you take the loss via remeasurement component. You seal your asset basically, right? So this is IS 19, very simple and easy standard. Again, if you understand this format and you understand what is added and deducted, it's very easy to sail through. There can be plan amendment, settlement, curtailment in pension plans. Okay. Whenever they happen, guys, whenever plan amendment, settlement, curtailment happens, you have to ensure that after the amendment, settlement, and curtailment, you are changing your assumptions, you are updating your assumptions, and you are updating your interest rates. So this is a new change that happened in 2019 in IS 19, that whenever amendment, settlement, curtailment occurs, you have to change your assumptions and interest rates. That's it. Then lastly, IS 41. Let's have a discussion around IS 41, agriculture. Now this is a standard which is not likely to be tested, but still just for, because we've not done it in the syllabus, because ACCA said we're not going to pay attention to it. But just in case it comes up, because in one of the past papers it was seen. So that's why let's discuss IS 41 as well. Agriculture. Just a brief view of it, because you've already done it in FR. So IS 41 talks about bearer plants. So basically, let's suppose there's an apple tree and you have a forest of apple tree. Now, these trees that you have are your bearer plants. These are your assets, non-current assets. You have to keep on recording these non-current assets at fair value, less cost to sell. Okay, you have to keep on recording them at fair value, less cost to sell. Now, these apples are there. The time up till the apples are on the bearer plants, they are part of bearer plant only. But once I cut these apples, they become part of my harvested product. They become harvested product, which is then further treated as inventory. So it becomes my harvest, which is again recorded at fair value less cost to sell with gain or loss reported in P&L. And then I move it into IS2 inventory, where I record the inventory at lower of cost and NRV. So this is what you need to know, that first there is a bearer plant which is recorded at fair value less cost to sell. When you cut off the product from it, that day also you take that product to fair value less cost to sell with the gain or loss reported in P&L. And once you keep it and store it in your warehouse, it becomes part of inventory, IS2, where you record that apple at lower of cost and NRV. Okay, so this is what IS 41 basically looks like. So this is what I wanted to cover with you today, where I've basically done with you non-current assets, where we've done IS 16, 38, 40, 36, IFRS 5. Okay. Then we went to revenue. Then we went to leases. Then financial instruments, group accounts from basic to advanced, IFRS 2, IS 19, then a crux of IS 41, which is very less likely to be examined, but just in case it comes, I've given you a crux of it. Right? And then there are more standards like IS 37, where we talk about provisions. If it is like highly probable that, if it is probable only that you are going to end up paying some amount, you record a provision of it. If it is possible, then you record a contingent. Record means disclose a contingent liability, right? Then for contingent asset, you record it when it is virtually certain. Otherwise, you just disclose contingent asset. Correct? That is IS 37. In that, you also have restructuring provision. So if restructuring is happening, environmental provision where you have to calculate the present value, all these things. So these are small standards. Then you have IFRS 8, operating segments, where you first define what an operating segment is. What is an operating segment? Which is something separate, whose results are financially available separately, and the chief operating decision maker is using those results for their analysis and internal decisions. That is a separate segment. Whether it is separately disclosable or not, should I separately disclose it or not, that depends on rules. The 10% rules. Yes. So revise those 10% rules, IFRS 8, small but important standard. Then after IFRS 8, what we have is IFRS 11, joint venture versus joint operation. So what is a joint operation? When A and B together, they start one operation. So they share the income and losses in that one operation. So they share the profit and loss. They record their profit or loss in that particular operation. What is a joint venture? When A and B together start a separate legal entity and they have 50-50 in that entity and there is a unanimous consent. So how do you treat a joint venture? Just the way you treat associate. IS 28 applies to joint venture. Equity method of accounting. Okay, so this is what we have from other standards. Then you have IS 10, adjusting, non-adjusting events, small standard. Then you have technical articles. You have various technical articles. Let me share the link of the class with you where I've covered these technical articles. So let me just... Okay, I'm going to put on the links in the description box as well. So there are technical articles on which I've made a whole playlist. So if you search on YouTube, playlist on technical articles by Tashwita Gupta, you'll find it. I'll also paste the link here in the description as well. So technical article videos are available. List of technical articles I've covered. You can check this out here. See, these are the technical articles where we have talked about accounting ethics in digital age. Then we have reclassification of profit from OCI to P&L, right? Then we have sustainability reporting. Integrated reporting is not there in your syllabus, but sustainable reporting is kind of similar. But now we have IFRS S1 and S2 on it. So I'll share that too. Then alternative performance measures, APM, debt versus equity, crowdfunding. So uh, all of this is part of, what do we say, SBR technical articles, right? Okay. Then further, what you have is this session. This is basically the IFRS 18 and 19. This was a new standard introduced. IFRS 18 and IFRS 19. This was a new standard which was introduced, okay? And it's very important that you actually go through them. Very important, extremely important. So again, I will paste the link of this video with you. Then you have IFRS S1, Sustainable Reporting Standards, and S2. This was also a general current issue. So you will again go through this. I will share the link with you. And then there is one last video on current issues, latest current issues, which is like a 40-minute lecture, which you can go through once just to understand what current issues we have, like cryptocurrency, management commentary, materiality, all of that. Okay, so these are the things that you have to cover. When I talk about technical articles, it's not long. If you see the technical articles, it's a 22-minute video, 37 minutes, 35 minutes, 15 minutes. So whenever you're free throughout the day, you have still days left with your preparation, you can watch these lectures. If you are someone enrolled, then you've already watched it. They're already there on the portal. If you're a self-study student, then I'm saying that, okay, you can still watch these lectures. So technical articles sorted, IFRS 18 and 19 sorted, IFRS S1 and S2 sorted, current issues, again, YouTube video is there. It is sorted. I will attach all the links, okay, in the description as well as this PDF. That's it. Now, before we end this session, okay, so I am done with what I wanted to cover with you today. We might have extended the class a little, but that's okay. It's just for the sake of quality. It was by half an hour, but I hope that's fine with you. We have done our best. We have given 4.5 hours to this whole setup where we have understood a lot of standards. And I really hope that you took something beneficial from the class. Now, what are you supposed to do in the remaining days? If you are someone who had been following my ultimate planner, the SBR challenge that we started, what are you supposed to do in remaining days? There are some must dones, something that you must have done. Number one, you should have done with super 20 questions. I am going to post a video tomorrow on wood fleet. That basically is a video which my students already have covered. So crash course student, post result batch, regular batch students, you guys have already done it. Okay. So you don't watch that. But for the students who might have been not done with wood fleet, I will post that video because it's very important. Okay. Even if you're self-studying, do watch that video. Super 20 question, wood fleet. And you have to complete the full list of super 20 questions. Make sure you have done that. Very important. Second, you should have done pre-mock by ACCA. You should have at least given one mock in the time pressure so that you are not in the Delulu world that I'm done with everything. I will pass for sure. I want you to give one mock and get the reality check and work on your weaker areas. Fourth, must have watched this grand revision and must have done IFRS 18, 19, S1 and S2. So basically the links that I'm talking about, the current issues in the technical articles that I'm talking about. That's it. So if you have done these things, okay, good. You can relax now. Whatever you feel like, you can do that thing. But those who have not done with these things in the remaining days, that's what you're going to do, right? That's going to be your agenda for the remaining day. That's it. So IS 12, defer taxation. It's very simple. When the tax base is greater than carrying amount, what happens? When the tax base is lower than carrying amount, what happens? So if tax base is greater, that means you have paid more tax today. So you'll pay less tax tomorrow, right? So if tax base is greater than carrying amount, that means it's a deferred tax asset. If tax base is lower, you have paid less tax today, you'll have to pay more tax tomorrow. So that's a deferred tax liability. So in various situations, like in group accounts, when you're acquiring a subsidiary, you do fair value adjustments. This leads to deferred tax asset or liability in that situation. Okay. So you have to just cover all of that. Super 20, come on, you don't know the Super 20 questions. I've already shared it on my YouTube channel. Please check the Ultimate Planner. It's there in the Ultimate Planner. Or you can drop a message in any of my free groups. I'm sure someone will help you. Right? Ratios are part of your additional performance measures. Now, instead of additional performance measures, we also have MPMs. Okay. So ratios and KPIs I've covered in this section of technical article, where you can see here alternate performance measure, the technical article. These are 10 technical articles which I've covered in 4 videos. So that's what you have to do. Okay, so KPIs and ratios are there. So basically in APMs, you should just know what are the benefits of APM, using APM. That's it. So this is how we end the session. Like after 10 minutes, you will see the description box with the notes which we used and made during the class, with the links of videos that you are supposed to watch, and your WhatsApp group links if you're not already part of the free WhatsApp groups. You'll find the link in the description box. So that's it, guys. I hope it was a helpful session, and I would appreciate a feedback after the class in the comment section once the live class is uploaded. Whatever you write in the chat box right now, it basically vanishes. So when the class would be uploaded, like just after I end this, you can comment your feedback in the comment section, and that would be really helpful for me to improve further and for others to, choose this session to be watched with their paper. So that's it. Thank you. And I really applaud all of the people who have attended this for 4.5 hours. Come on, you guys have made a new record. So all the very best. May God bless you all. Thanks for attending this session, and I hope it helped. See you around with AAA, not SBR again. All the best. May you all pass with flying colors. Goodbye.